Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, everybody, welcome back. Happy Friday. Hope you're doing well. And get my intro music playing here. Hey, it's Friday. We got PCE numbers coming out here pretty soon. I was just checking the stream schedule here today. By the way, if you are a regular stream viewer, head over to a1trading.com, and in the top right hand of the screen, we've got a live stream schedule that James and Chandler put together each week to help everyone keep up to date with what the show's looking like. This helps coordinate our guests. It helps us internally coordinate the shows. And of course, it helps the viewers to keep an eye on who or when is going to be on the show at what times. We got a nice loaded here schedule. We'll be going up to noon today, which is awesome, and should be a lot of fun. Trayvon says, I haven't blown my accounts in months, which is awesome. And, here's the thing. For some traders out there, everybody's at a different point in their trading. But Trayvon saying, I haven't blown my account in months as a major improvement is awesome, because some people are still stuck in that phase. They're still stuck in, I want to go fast. I want to make money quickly. I keep blowing my account. And by the way, 99.99 times out of 10, when you blow your account, you were just trying to go too fast. Take that with you. If you blow your account or you do it frequently, you're going too fast. You're trying to rush the process. The reason people say that trading is not a get-rich-quick scheme is because if you try and treat it like a get-rich-quick scheme, you blow your account. That's just what happens. You try and go too fast. Let me put something else out there into the universe today, and hopefully somebody takes this to heart. There's not even a question. There's not even a remote possibility that I blow my trading account because my risk sizing is so small and so defensive. It's not skill that I don't blow my account. It's not because I'm good at calling the markets that I don't blow my account. The reason that the trading account that I show you guys, my positions, all that stuff, has a 4 or 5 year track record or whatever that I've, brought up on stream. The reason is not skill that I'm still here and haven't blown my account. The reason is because my positioning size is not ridiculous. That's the first half. Right? First half is position sizing. Okay? If you're blowing your accounts, your position sizing is way too big. Way too big. Like divided by 20. And that's probably what you should size your positions at. Okay? And if you can't, if you're like, well, I'm already using a 0.01 and blowing my account, then unfortunately you've realized that trading does require some capital. And as annoying as that may be to hear, if a 0.01 lot size is killing you, then first of all, you might be trading, like if you're someone who trades on the Forex side of things, 0.01 lot size, if you're not a Forex trader, lots is what the Forex traders use. Contracts is what options and futures traders use. Shares is what I use, like stock traders. There's all different types of things. My point is this. If you're position sizing, if you're blowing accounts, it's because your position sizing is ridiculous. And you need to smack yourself on the wrist, give yourself a nice little tap on the wrist and say, what are you doing? Okay? I know somebody out there just did that. I know somebody just said, What are you doing? Not just me. The other thing, it's not a skill issue. Okay? Let me also make this point very, very clear, okay? If you are blowing accounts frequently, your position sizing is too big, but you ready for this? If you are blowing your accounts, it's not a skill issue. Get that out of your brain. That's dangerous. If you're saying I'm blowing my accounts because my skills, my strategy is not good enough, nope, you missed it. Nope, you missed part one. If you are blowing your account, even with an incredible strategy, if my position, so even like the best moments of my trading strategy, I still have like drawdowns or losing streaks, etc. If I was putting inappropriate risk on per trade, I'd still blow an account after years of learning about this stuff. I'm not the greatest trader of all time, not at all. But I can tell you that if you're blowing accounts, it has nothing to do with skill. Blowing accounts has nothing to do with skill. Let me say that over and over and over. It has nothing to do with skill because it's all about you're using inappropriate position sizing. David said I just smacked my hand. Give it up for David. Being honest, and we're trying to keep it honest here. I've been on a roll recently on the streams. I've been having just like harsh takes. I don't know. I've been very passionate about the topic of trading recently. I think I've been watching a little too much Words of Wisdom. I love his show, man. He does some great work. I know, there's some controversies, and I'm just saying I really like the conversations. The conversations are very good. But yeah, we got 5 minutes to go here before we have PCE numbers coming out. Gold is up a little bit here. Come on, guys. Can we get that gold to break through that level? We discussed this yesterday. Game plan hasn't changed for gold. I'm already long gold. I went long inside of the Discord. If you'd like to keep up with my trades, you can join the Discord. It is a service that we offer. If you'd like to join the Discord, I'll put the link here in the chat because I don't think anybody is in the office just yet to help out with support messages. All right. If you'd like to join the Discord, there is the information. a1trading.com/VIP. All right. So here is something to consider with gold. As we get close to this high, this is what I'm looking for. And this could happen with PCE numbers, or it could completely reject again. 1, 2, 3, 4. That would be the 5th time on this 4-hour chart that we reject this level. And you might say, well, Nick, if it's rejecting it every time, why aren't you getting out of this? Shouldn't you be taking profits? And for me and my trading style, I know that some people prefer to just like take profits at a level of resistance, and that is totally cool if that's your style of trading. I get that question a lot. Nick, why didn't you lock in some profits? Nick, why didn't you take partials? Nick, why didn't you do this, that, and the other? For me, I am looking for big moves in the market that don't happen that often. I like to think of it as like fishing. Like I'm going fishing. Sometimes you catch the big one. Most of the time you don't catch anything. That's what I'm looking for in the markets, generally speaking. In my personal P&L, most of it comes from a select few trades, and that's always how it's been, for me. I'm not saying that's how it's supposed to be for everybody. Some people like to play for base hits. Some people like to hit for, second base. Some people just like to get on any base, take profits then. I'm making baseball references. But for me, I like to make home runs. And I don't say that like, oh, yeah, I make home runs all the time. No, I make them really infrequently. But when they happen, they make a lot of money for the losses that I inevitably have to pay in order to find those good trades. So I'm in a decent one right now for gold, but it has the potential to either be a monster if we can break through this high. If we break through that, then wonderful. Then what I will do, I made this point yesterday. We got 4 minutes to go, or 3 minutes to go here. Don't let me miss news. If we get something like this today, if we get a nice close above the highs, that will give me the green light to say, okay, high or low, let's put a stop loss just below there and move my stop here to there. So I'm looking to see if PCE numbers can help the story or not. Now, what if PCE numbers come out not favorable, meaning inflation is hot and Fed may not cut rates as much? Yeah, that could lead to price going down. And what if, Nick, it comes all the way down and breaks support and you actually lose money on this trade? And I'd say, well, it happens sometimes. And I have to accept that. Some traders could not handle that. And I don't say that as in like, well, because I'm the best, I can handle it. No, what I mean by that is some traders are like, nah, I don't resonate with that. I can't do that. Like that psychologically doesn't work for me. And there is some serious components to that. Like it's got to psychologically work for you. Some traders like, I got to lock something in. I can't sit right until I lock something in. I get that. That's fine. For me, I'm not that way. I am very patient with my trailing stops. So if I'm right about this, fundamentally, I think gold keeps going higher. I've been saying that all year long, and that's been a pretty decent call for me this year. I've had some losers in the midst of that on the technical side, but I've been right in the direction. Gold higher this year. So for me, what I'm looking for is a breakout here in order, if we can close above these highs, then lovely, I will be trailing a stop loss. And if it goes higher from there, then I'll trail a stop loss again. So I'll keep you guys updated in the Discord. We've got about a minute to go. So let me go ahead and switch over to the all markets. We've got 630 people here between all the different places we're streaming to. Thanks for being here. Shout out to you for sticking around with me. Make sure if you're new, hit the thumbs up button, subscribe, follow if you're watching on Twitter. And we do this every day. So it's free value. I hope that it's beneficial to you. We're not trading the spike. Please understand we don't do that here. We trade the aftermath. We talk fundamentals. We actually discuss what the data points that came out tell us about the economy, tell us about what the Federal Reserve may do next. Predominantly, fundamental here, which I know is not the norm. I'm a little prideful about that. I like being a fundamentalist when everybody else is just technicals. It's kind of like, I don't know, it makes me feel special. But anyways, got about 15 seconds to go here. We'll go ahead and roll our breaking news. Stay tuned. All right. PC numbers coming out in just a second. Okay. PCE numbers, where you at? Alan says mixed. If anybody has the numbers, let me know. Okay, there we go. 2.6, better than expected on the core year-over-year index. 0.2%. Any revisions? No revisions. 2.6. All right. We will take 2.6. That is better than expected. For stocks, gold's going to probably like that. Dollar index, not so much. We got NASDAQ continuing higher. And you got to know also, you got to think about this. If you're saying, well, where's the reaction? Market actually moved higher into this news on both gold and NAS and S&P. 2.6% year over year. That's nice. We'll take that. Remember that the PCE number is what the Fed typically says is their preferred measure of inflation. So this is really good to see. 2.6% seems to be continuing the trend of disinflation, which is great. That gives us more confidence that the Fed is likely to begin cutting interest rates. I mean, they've said as much. They're going to cut rates. What we're more now focused on, guys, is how much are they going to cut rates in September? Are they going to cut by 25 basis points, which is 0.25%? Or are they going to cut by 0.5% or 50 basis points? And people are trying to figure that out, because if you get a 50 basis point cut, gold's going to rocket and the dollar will sell off hard. And if you get a 25 basis point cut, gold's probably not going to move too much further than where it's at. Does seem to lean more towards the 25 basis point side of things. Let's go back to our all markets view here. Take a closer look at what's happening with gold first. So gold on a 4-hour chart, still just chopping around here. Didn't seem to give us enough juice to really break the highs or anything like that. But the day is young. I mean, yesterday we started out low and then proceeded to pump right back to the highs there. So I'm watching gold. I think that it has the potential to break these highs. Could be today, maybe Monday. We'll see. But you've got this kind of interesting little formation here towards the highs where you're getting some higher lows potentially. I'd love to see this thing break and close above the highs today. If that happens, I'm going to trail my stop loss, which would be awesome, just to lock something in on this trade. So we'll see. So again, I do like gold on the long side. I also have a nice general confirmation on gold. We're getting a +7 reading on the Edge Finder, which means that when looking at the economic statistics, sentiment data, technical reads, we're mostly leaning on the bullish side, which is a good thing to see if I'm long. Commitment of traders data, I went through that yesterday. Smart money, institutional money, big money, whatever you want to call them, hedge funds, banks, they have pretty large positioning on the long side, according to the non-commercials COT data, showing, again, big money is long gold. Seasonality, still very okay for gold. It changes a little bit in September, which hurts the case study a little bit, which is, of course, today is the last trading day of August. Trend is to the upside pretty clearly. GDP stats came in pretty strong, not great for gold. Manufacturing PMI, services PMI kind of mixed. Services PMI came in strong, not great for gold. Manufacturing was weak. That is good for gold. Remember, poor economic data leans a little bit more towards bullish gold, because it means the Fed may cut rates. It means that they may print a lot more dollars to sort of stimulate the economy, hence making the price of gold go up. There, retail sales came in strong, not great for gold. But then labor data here, which we're going to watch next week really close. Next week you have NFP. So NFP could change these scores or keep them as is. And then you have interest rates coming down. That's very positive for gold. So overall, I really like the risk to reward for gold here. I don't like the price action right now for entries. There's nothing to do on the entry side of gold. Somebody asked me yesterday, Nick, is there any levels that you would add to up in here? And I'm like, no, the entry was here. And I know that sounds, of course it was in hindsight. I did buy this, I bought GLD, which is the ETF. And you can see my entry on this one was pretty dang rare to get it that good, but it popped right off that level. And so I'm looking for gold to move higher on this one if I can. Then I will, if I can see that, then I will trail a stop. So that's the update on gold. By the way, Edge Finder is currently 35% off. Today's the last day for that. So if you are looking to get a copy, 35% off the Edge Finder. Then we'll drop a link here in just a second to send a message to our team if you'd like to get some information about the 35% off sale. It is ending today. So you can get access to our tools, all the commitment of traders report data, access to our top setups algorithm here, all the economic reads, etc., can all be found in the Edge Finder. So if you're someone who is wanting to incorporate fundamentals into your trading, highly recommend getting a copy while this sale lasts. Again, 35% off, ends soon. Nick, I want to be your mentor. I could use some mentorship. What are you going to mentor me in? So we will see. We will see where gold can close today. It should be interesting. Stocks, S&P 500, a little bit mixed response here. RTY, this is the Russell 2000. Dollar index. Dollar index actually came in a little stronger after that. It's interesting. All right. Sorry, I just had to send a message to my team really quick. All right, so we are looking at dollar index up a little bit here on the day. Gold's flat, silver's flat, oil pretty much flat, stocks basically flat. Nasdaq's up a little bit here. Nick, I think the personal income is pumping dollar up. Yeah. I mean, it's not, there's no huge moves happening here right now. So it's, could be a little bit of that, could be a little bit of this. What is that score calculation based off? Good question, Milky Way. We actually have a, check this out. So if you're somebody who wants to learn about how the Edge Finder functions, if you go to a1trading.com and then you go to Edge Finder features, you can read about how everything works here. So features, check this out. My team and I built this, which you can read through how everything on the Edge Finder functions. And I mean, the thing is with the Edge Finder, it's our pride and joy. I mean, this is the result of our years of trading. Frank and I and my team and I, you know, everybody on the A1 side has worked tremendously hard just to make the tool what it is, but to create something that allows traders to better understand fundamentals. Here's the gap in the market that we see. Gap in the market that we see is that fundamentals matter, but traders don't use them. Why does everybody in the retail trading space only do technicals? I listened to a podcast last night where it was a panel of people discussing. It was a words of wisdom thing, and they were talking about how, oh, I don't mess around with fundamentals, and everybody laughed and agreed, like, oh yeah, technical only trader. And I was like, you know, that's fine if you are a purely technical trader and you've done your thing, then great. But for the 99% of people who are trying to use technical only trading strategies and losing money, they never even get a chance to learn fundamentals. They don't even hear, nobody talks about fundamental analysis except for, you know who does? And I make this point all the time. So if you've heard me say it, you know where I'm going with this. You know who does talk about fundamental analysis? Hedge fund managers. Great, fantastic money managers that have billions of dollars. They're not talking about a head and shoulders pattern or a moving average cross. They may use very simple levels of technicals involved, but I've listened to a lot of them. I listen to them all the time on, like, you can listen to CNBC and listen to people who manage a lot of money on there. And are they talking about technical analysis? Nope. Maybe a little bit, but they're not using technicals. They're using fundamentals. And so I want to just say that if retail is all using technicals, But then professional money managers are focusing heavily on the fundamentals. There's got to be something. There's got to be a reason they're putting themselves through the agony of learning fundamental analysis, right? Because fundamentals are not easy to learn. But why does retail only focus on technicals and these money managers are all about the economy, the Federal Reserve? Why are they all focused on that? Just got to ask some questions, right? We just got to think here for a second. It's almost like, if you want to get conspiracy for a moment, it's almost like they want you to just stare endlessly at charts. Don't look at this stuff. Don't look at that stuff. That's for people wearing suits and making billions of dollars. So yeah. I just make that point regularly because, again, I think it's really important that we understand you don't always want to just try and do the same thing everyone else is doing. And it really is so important that you understand. I mean, if you are somebody out there and you're listening and you're like, I use technicals only and I make money, then I am not here. I'm not talking to you, because there are people who use technicals only and do just fine for themselves. I'm not here to say that you can't do that. I'm not the father of the markets. I don't get to tell everybody else what is right or what's wrong. Like, that's not my role. I'm just saying that for me and for many other traders who have embraced what we do here, it's been a breakthrough for a lot of people. They start understanding how the markets actually work. They don't, the other thing I like to say about fundamentals, why fundamentals matter, is because fundamentals apply to all of humanity, and technicals apply to a very small, tiny minority of the whole globe, which is traders. Traders look at technicals. The whole world involves themselves in fundamentals. If you don't believe me, hear me out for a second. What do you mean, Nick? If everyone's involved in fundamentals, what are you talking about? Well, we all know how the gas pump prices feel. We know how the grocery store impacts us. We know how hard or easy it is currently to get a job. We know if our job is paying us, if the wages are going up, if they're not going up. We know who the president currently is, who it might be. The whole world, these are the real forces that move the markets. These are the things that only traders look at. So when people say fundamentals don't matter or don't move the markets, are you kidding me? That's what we all use in all of our lives, is fundamentals. Real demand for the latest PlayStation that just dropped, that is fundamental analysis. Real demand for the latest Xbox, right? That impacts Microsoft's earnings, right? Fundamentals is like a grid of reality and how it impacts the markets. And technicals, I'm not saying technicals are not useful. I'm not here to say, oh, if you're using technicals, they're plenty useful. I use them all the time. But I'm saying that we have to be humble enough to say this is only for traders. This is for absolutely everyone on planet Earth. What does Jim Cramer use? That's a good point. He does use fundamentals. But the other thing about fundamentals is that just like technicals, there's a wide arrangement of ways that you can apply strategies, so on and so forth. I would agree with this. I think the best is to marry both fundamentals and technicals. Totally agree. So yeah. Anyways, we've got gold here, still flat on the day. I mentioned earlier, if you missed that, I'm just looking for a breakout here in order to trail stops on gold. Let me see really quick. Still got NASDAQ bullish reads. Here's an updated look just real quick at current setups on the Edge Finder. Oh, look at that. Bonds are back up here, which is interesting. Bonds might be interesting. Euro, pound. I'd like to look at those. I talked about them yesterday on the video. Gold, NASDAQ, DAX, silver. And then on the bearish front, we got USD JPY, USD CHF. All right, guys, we're going to take a quick break here in just a moment. Before I do, let me just remind you, it is currently 35% off to get access to the Edge Finder. We'll drop the link here in the chat to speak with a member of our team if you'd like to get access to that. You can ask any questions you have about the tool. You can ask about if you want to pay with crypto, if you want to do a payment installment, whatever you want to do. Just chat with a member of our team. They'll be happy to help you out with that. And they're standing by, real person, no robot or anything like that. You're talking to a member of my staff if you have any questions about our tool, etc. All right, stay tuned, guys. We'll be right back with Kenzo here for Fundamental Fridays. We'll be right back. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out, in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. All right, and we're back with Kenzo from Extra Hot Forex. Hey, Kenzo, how are you?
I'm doing great. Thanks, and you, man?
I'm doing well, and it's good to have you on the show. Talking markets here. We just had the PCE numbers came in a little bit lighter than expected. Was curious your thoughts on, well, I guess, which markets are you watching the most? I know you trade like me, you trade a basket of different things, trade currencies, trade indices, gold. What are you mostly watching right now?
At the moment, I was still on Nasdaq, USD, and also gold. Sorry, and also US oil, because it was moving very nice. So yeah, but mostly I can say Nasdaq and actually US as a whole, because they have a direct impact to each other.
Sure. So you've got the dollar index pulled up here. A little bit of a pop in the dollar this morning. Are you thinking that the dollar continues lower? I'm kind of in that camp personally, but what are your thoughts on the dollar index?
Yeah, I believe we're still gonna see a very nice move to the lower side, because PCE, it was like very cool. So it's not really a bad thing, or maybe a good thing. We can say it's neutral. So I think we can still see a continuation of that sell, because at the moment this sell, it's because we now expect, or we are very closer to the rates cuts. I think this is the few days until we reach September. So which means from there we will be just talking about rates cuts, and this is the first pair to be impacted by that. And almost every economic news that we got, they all actually very, very, very cool, or we can say they did not really actually go aggressive.
Sure.
And that is actually what we want. I think I'm expecting it to go lower. If it doesn't really go aggressive, I'm just expecting it maybe to consolidate slower, but not really going up that much.
Yeah, and when it comes to the dollar index, when you have these pullbacks, as you mentioned, the inverse relationship to gold, so you have gold sort of moving down here today. It's not a perfect correlation. Gold and the dollar can technically move in the same direction, but today seems to be, weighing a little bit on the gold price action. I was curious your thoughts on this one, because if we do see, a little bit more selling on gold, that would put it at 1, 2, 3, 4, the fifth time here on the 4-hour chart that we get a rejection from this level. Do you think that's telling us that gold is topping out in this area? Or do you think we're just consolidating before potentially breaking through that high and continuing past that all-time high around 25.30, let's call it 25? Yeah, about 25.30.
Yeah, I think we have a very nice structure. What's really happening there, I think it's a very clear resistance structure. I feel like we have like 1, 2, 3, 4, 5 touches. One way or another, I think the market will be trying to break out of that structure. We can see that even though the market is trying to go a little bit lower, but it's not really that enough. Bullish momentum is quite aggressive. And I thought maybe PCE was going to change that, but a bit disappointing. So now I can say, yeah, there is enough room for gold to even go higher, because at the moment we're no longer going to worry much about PCE. It's just going to be okay. Now what's next? It's just about rate cuts or maybe few economic news that we're gonna have the coming weeks. But at the moment, I think it's about we're just waiting for gold to break. I don't think we have any barriers that can stop us from buying at the moment, because I think it's like clear that the rates they will be cutting the rates, whether it's 25 basis points or 50. But I think that it's still very good for something like gold.
Yeah, I agree. And I think that the concept of knowing that, interest rate cuts are coming has definitely played a role in keeping gold where it's at. I also wanted to discuss something on gold with you for a moment. When we saw gold make this kind of move at the beginning of the year, where you had this kind of really violent upward trend, as opposed to what we've sort of progressed into in recent times, which I would say is more of a kind of slow chugging uptrend. If you take a look at the trajectory of this uptrend versus this uptrend, very clearly, it is two different types of uptrends. Yes, they are both trending up, but one is gradual
Mm,
and one is very rapid. And the reason that I can attest that to is that we started out here, with a little bit of fear, right? Because you had conflicts arising all over the world. You had, sure, the Fed was expected to eventually cut rates at that time, but it was a lot of fear. Whereas now there's just more emphasis, it seems like, on easing. So the two different uptrends, I'm curious to get your thoughts on this if you agree with this, but I think that the reason the trend is still up but gradual is because the Fed cutting rates into a soft landing is good for gold, but not phenomenal for gold. I think that if you had cuts plus fear, like rate cuts plus like fear in the economy, you would get this sort of move again. And some traders might think that, hey, we might go into that fear of again, and that may cause a melt up on gold if you get, rate cuts for, trying to save the economy and things are crashing. That would be possibly a very bullish kind of couple of years for gold. Whereas it seems right now we're more in this camp of we're easing gradually from the Federal Reserve. Doesn't seem like a crisis, and that still favors gold for rate cuts, but not nearly as urgent to buy gold as it is in a fear environment. Does that make sense to you?
yes, you're right. Remember, that's the reason why we say gold is actually a safe haven, which means a safe haven. It means things will be going crazy around those times. If you want to buy
Mhm.
gold, it means things are not going very well. Maybe there is geopolitics and stuff. But when we cut the rates, like now, we can say by cutting the rates, that is going to be good for consumers in the US and stuff. So that is actually a good thing. It doesn't really create any panic, you see. So actually,
Yep.
gold, we can say, I like to say this, it's like gold and VIX. To me, I think they were supposed to be the same, because mostly they measure fear. If maybe you see gold flying, most likely there is something very bad happening around that time. But if things are cooling off, most likely you will see it performing very not really that good. So I think rate cuts are good for gold, but it's not really everything. It's not gonna fuel gold to go crazy, you see.
Yeah, no, that makes sense. There's got to be that for gold to go up in that trajectory. There's got to be like urgency and fear to buy gold rapidly, whereas now there's just like a steady demand for gold alongside other things that might do well in a rate cut environment. We talked gold for a moment there. I want to also hear your thoughts on the Nasdaq, Kenzo. So Nasdaq's been bouncing back here. Is the uptrend back? Are we still? Do you think we'll see perhaps a hit of the all-time high again before the end of the year, or do you think we may go sideways? What are your thoughts on the Nasdaq?
Yeah, on the Nasdaq, I think I'm expecting to see a continuation of a bullish move. Yes, we're coming from this aggressive down or aggressive sell. At the moment, I'm expecting actually a reversal, even though it might not really happen very quick, the same way as the previous sell off. But with the way we see things now, we just received some earnings from Nvidia, which shows that yeah, we still have that AI continuing. The demand is still there, and mostly, I think maybe sometimes it's we focus too much on Nvidia, but we don't really focus on Microsoft, Amazon, or other companies that are buying those GPUs from Nvidia. So if you check
Mhm.
how they talking now, beside Nvidia, you can see that they are still going to buy more. So which means Nvidia alone, yes, maybe people that might sell now, but actually we can still see enough even to next year. I think we can still see a nice push to the upside. Along the way, people they will take profits, or investors they will try to cut their profit. They will try to rebalance their portfolios, and that it comes with a cost. Once they cut that, obviously the market will perform very bad. But after that, the market will recover, because what we see now is not really like bad performance from those companies. It's just that people they're just cutting their profits. I think this last month we saw Warren Buffett. He took his profits, actually, or let's say he sold his shares from Apple. So obviously, once we see something like that, we're gonna see a major sell. But it doesn't really mean the company is performing very bad. So I think that is also what we see on Nasdaq. When the market is higher, obviously people they will take profits. Once it's lower, I think it's gonna be a very good time for us to look for a continuation of a buy. Plus, we have rates cuts coming, so that is
Yep.
also another plus. And we saw the results. They did beat the estimation, but unfortunately, most of the time it happens like this. Every time they, let's say, mostly these bigger companies, when they release their earnings, the market tends to sell. I don't know if maybe people are just cutting out their profits before, because the market mostly it will be on the highest level.
Yeah, Nvidia was an interesting one, Kenzo, because Nvidia, it did beat its earnings, but it didn't beat them by the same percentage. Didn't beat them quite nearly as much as it's beat them in the past. So here was a 20% or 19% beat on earnings, 12% beat on earnings, 9% beat on earnings, and then the latest one was just a 5% beat on earnings. So it's like, but that just goes to show, to your point, they beat earnings, market still sells off because the expectations for this company are so high. That being said, though, the way I take this is still very positive. They beat their earnings. It is still a growing company, and the revenue growing like that may not be, absolutely dazzling to some of Wall Street, but it's still very good growth. It's still showing demand for semiconductors, and in terms of the rest of the tech trade, I think it still is still intact. Not to mention, as you just discussed, if we have the Fed cutting interest rates and the economy holding up, the demand for chips is probably not going anywhere for a while. And so, if we continue to see the economy, see evidence that it's holding up in the meantime, it could be just fine. And some economic data points just to reference is we've still got PMIs here at 51.4 compared to previously we were at 48.8. So services is still growing. Manufacturing is not growing, but it's not falling apart. This has been kind of a consistent theme for a while. So manufacturing is slowing very gradually. And then look at GDP growth. If we take a look at GDP growth, yesterday we had remarkable GDP numbers. And this is just
Mm.
continuing to show that, for people who are very fearful of a recession, it's possible that we do go into a recession at some point. But remember, a recession is 2 consecutive quarters of down GDP, negative GDP. And we're still putting up some pretty strong growth in the US. So the point
Yeah.
is, if there's good GDP numbers, this is also very generally good for semiconductors, very good for company earnings in general, because you want to see the economy's growing, the hiring stay strong, if we can get some bounce back in labor data, that will be very convincing that we could potentially see this soft landing play out, where the Fed actually does end up seeing inflation come down, cutting interest rates, and that spurs and keeps going with the growth from here. So it is possible that we kind of see that dynamic play out, and could be very interesting. But again, economic data overall looks decently strong enough, especially with rate cuts on the horizon. And I do think that path of least resistance for indices is higher until proven otherwise. I think with the indices, Kenzo, we've kind of got to think of them as innocent until proven guilty, right? They've been doing remarkable. They've been putting up great numbers. Let's see if they can. They're innocent until proven otherwise, right?
Exactly. Yeah. Plus, on the indices already, we did have a proper sell off, I think, few weeks ago. So I think that it was enough because it happened very quick. So for now, for the market to recover, I like the fact that it's not really recovering very aggressively, because if it was aggressive, maybe it was supposed to reach this level. So at the moment, we're still at the middle, which means it's good. If maybe the market start to go higher, it's fine, because that maybe might be throughout September until they cut the rate. So to me, I think it's fine. But if maybe the market was just jumping straight up, that was going to be a problem. Maybe we were going to have another sell off again. But this sell off that we had last week, I think it was enough. Maybe the market might not really give us those bigger moves, but it's better if it keeps going up slowly. I think the economy, obviously, one way or another, as you said, GDP is performing very well. Two in a row means we're not actually expecting any recession anytime soon. And that obviously it has to reflect on our indices, but I think it will be quite slower. But the rate cuts, we'll just have to wait for them, whether they cut with 50 or 25. I think that will still be good. Unfortunately, just because we're talking about it that much, once they cut with 25 basis point, that won't be any surprise, or it won't entertain investors, and the market might not really move that much, unfortunately.
Yeah, and I think that even if it doesn't move that much, it would be just fine, because we've had a nice bounce back. We've had, some nice gains in the S&P, and the actual announcement of rate cuts are unlikely to be a very big market mover. Like the actual day, usually the market already knows with pretty good precision what they're going to do. It's more about the rumor for the future ones, right? So as we get closer to September, the market will get a pretty good idea. It seems right now like 25 basis points is appropriate, not 50. And if that happens, then the market, I would actually say that's a really good sign. If you get 25 basis points instead of 50, that would tell me, okay, we're seeing, the Fed ready to cut rates, which is great, but we're not in a rush to do so, which is also great. Shows that they think the economy is in a good enough place. If you get 50, it's a little up in the air. If they say 50 basis points instead of 25, if that were to happen, it would depend how they deliver it. Because in some ways you could say, they may have missed the starting point. They might have gotten it wrong. That might concern investors. But if they deliver it in a way where they're like, we feel we're sufficiently restrictive and we feel like we can start a little heavier on the front side and then proceed with like 25 basis points from there, I think the market wouldn't hate that. They'd actually probably celebrate it and be like, okay, yeah, rate cuts, that'll do something, and then go from there. But really, I've made this point many times, Kenzo, and I'm sure that you have as well. It's not about the rate cuts themselves. It's about where the economy is when they're doing the rate cutting and how fast they're doing it, right? So people are, constantly wondering, when they cut rates, is that going to make the market crash? But the full answer is, well, it depends on the state of the economy as they're cutting rates. Would you agree with that?
Yes, actually, you're right on that. So I also believe that they will be cutting maybe with 25 basis points, because 50, I think that will be somehow, I think they will be going aggressive or it will look like a panic from their side. Plus, we still have this for this year. We still left with 3 events from Fed for the interest rates. So if they increase with 50 basis points, what are they going to do with the 2 sessions that which are going to still come? Are they going to pause, or are they still going to increase? So it's not going to be nice, I think. So I think the best way it will be just go slow, because I think everyone can understand that inflation is lower, but still we don't really have to rush, because if they cut with 25 basis points, at least that it's 25 basis points of weight. We minus that weight, so at least slowly the economy can recover very quick. Because if they go aggressive, that can also be a worse thing they can do. But it might look like it's good for that time, but it might not really look good for a longer time, because if things changes, you know how CPI changes very quick. If NFP comes back as a way too aggressive as a positive, that might be something else also, you see.
Yeah, no, I
So
think
they have to
you're on the
go
right track with
slower.
that too.
I think maybe there is a delay.
Yeah, sorry about that. No, I was just saying that in terms of the pace at what they go at, I think that a 25 basis point cut would signal a little bit more confidence, that they feel like we've got room to go slow here. We don't need to rush the process, and I think that would make investors the least concerned. And that is really important to the story here, is that if the market senses or feels that Jerome Powell and his team are behind the curve, meaning they're cutting too late, it would be scary for the market. And if they feel like, okay, they're doing their job, we can kind of go back to just focusing on buying good companies, looking for good investments, and not worry so much about the Fed. That's really where people want the Fed to be. The Fed taking a center stage role is it's been the case for the last few years, especially with 2020 and all the inflation stuff. But it is important that we just kind of see a Fed that's like not threatening, but also there to assist and slowly help the economy as well.
Exactly. And plus, it's very interesting with the markets. So mostly with investors, mostly we care much about the confident, how they say everything they say. That's why when we have interest rates, the most important thing is not really the numbers, but it's actually the conference. Are they confident, or are there is any fear that maybe things won't go well? And I think investors, they care much about that. If maybe they sound like there is something not really good, then that puts panic on investors, unfortunately. And that's what will happen with the interest rates. We don't really care much about the numbers, but we want to see if they still have that confidence, or maybe are they on a panic mode. And that's how most people actually invest, unfortunately. And it's been like that. Sometimes you don't really care about the number, but we just want to understand, how do they see the economy, how is the economy going to perform, maybe in 3-4 months to come, or maybe even a year or two. Sometimes it's just like that.
Yeah, that makes a lot of sense. And again, it is a signal of kind of sentiment from the Fed for sure. Kenzo, I want to thank you for coming on the show here today and helping us out. Every Friday, we do this segment with Kenzo for the audience. If this was your first time hearing from Kenzo, super smart dude. He's come on for some time on the show, helping us out here to make the A1 Trading Show better. Kenzo has his own YouTube channel. We just dropped a link here in the chat. You can click his link there. Make sure to do us a big favor. Subscribe to Kenzo. Go follow along with his content. And you can hear his latest commentary on what's happening in the markets each and every day on his YouTube channel. So, Kenzo, thank you very much for coming on the show, man, and have a really nice weekend.
Thank you very much, man, and also your viewers.
All right. See you next time. All right, guys. Real quick, I just wanted to recap on something that I mentioned when it comes to the whoops, sorry, let me put my screen on. Just wanted to recap for just a second what we mentioned about GDP growth. So GDP growth, for people who are concerned about is the economy going into recession? We have to keep an eye on GDP growth because it shows us pretty much the output of the economy, right? So when we have really strong growth, GDP growth is typically high. And yesterday we had the preliminary GDP come out, and it came out at 3%. Is that right? Am I getting that wrong? Is that right? Forecast was 2.8 and we got 3. Am I making that up? I could be wrong in that number. And if that number is wrong, hold on. I got to check this. It's important. 3%. Okay. Yeah. No. Trust the data. Trust the data. Okay. So the hedge finder was right. I was wrong. It was revised to 3. Okay. Thanks, James. Yeah. So look at this. 2.8 was expected. We got 3. And again, the U.S. economy keeps chugging along, and people have been saying, man, for actual years now, U.S. economy is going to go into a major recession. And the thing is, will it happen at some point? Yes. And all those people will say, haha, I told you so. But the problem is, like, what if you missed out on like 200% of gains in the S&P 500 because you kept saying, oh, there's going to be a recession, right? When it comes to fundamentals, I don't try and forecast what all the future fundamentals are going to look like. I just look at what we're currently working with and I trade based off of that. If I was super long-term investor, then I might try to forecast future fundamentals a lot more, but I don't really do that. I'm a trader. So when I see this and I say, okay, look, GDP is healthy enough. If we go into recession, so be it. But that's not what we're working with right now. We're working with an economy that is still growing. We have services that are showing strength. We have manufacturing. We have a consumer that seems to just be holding out despite all the inflation. Yes, the consumer is hurting. Yes, we have some evidence of that. Don't get me wrong, but they're doing better than what people thought they would be doing. At least look at retail sales, right? Retail sales showed a 1% growth compared to just a 0.4% growth expected. When they were expected to decline, they came in flat. So my point is, if the consumer can hang in there, if jobs data can come in okay, right? We've seen some okay jobs data since that one, unfortunate NFP that came out last time. We've seen claims that have come out okay since then. We've seen job openings have kind of gone sideways. My point with going at all of this stuff at once here is that the economy seems to be in a place where it's like, okay, it's not doing amazing, but it's holding out. And I think we'll hold out long enough for those rate cuts to start stimulating pockets of the economy that are negatively affected by higher interest rates. And in relieving some of that pressure may help to excite the economy, get things going again. Now, what I'm talking about specifically is areas like real estate. Here's an example of a sector. Real estate is exploding off of what I just explained. People are saying, wait a second, real estate, which is very dependent on where interest rates are at, if we get some interest rate cuts, things might do a little bit better here. Financials would also do pretty well. Financial services companies, banks, people who are borrowing money might choose to go, the refinancing mortgage rate business might do better. You have some stuff here where it's like, okay, if rate cuts come in, there's also more cash flow to invest in small businesses who borrow a lot of money. Semiconductors probably could continue if the economy heats up again, right? We could have the consumer discretionary. Don't even get me started on this, right? Maybe people go out and start buying Nikes again. I don't know if you guys have, we had a conversation yesterday in the office about the shoe market has fallen apart. So maybe that's going to swing back. There are pockets of the economy that could greatly benefit from a reacceleration that stems from lowered borrowing costs. So I am currently still a believer in the soft landing. That is my base case, if you want to call it that, and we'll see if it plays out. I'm positioned for it. I'm long semiconductors, the Russell 2000 index, and the S&P 500, as well as I do have a position on gold as well. Those are my core positions currently. Guys, remember, Edgefinder is currently 35% off. Don't miss the discount. We're going to roll a quick break here in just a second before our next guest takes over the show. We got Forex James coming on. We'll drop the link to his stuff here. If you enjoy his commentary, make sure to do that. Also, if you'd like to get access to the 35% off sale, click this link. You can send a direct message to our staff who can hook you up with a copy. So don't miss out on that 35% off sale. It is ending soon. Will be over by the end of the day. So stay tuned on James. He'll be right here just after this quick break. Be right back. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Hello. How is everyone doing? I hope you're all having a great end to the week. So, euro dollar. Now, I've been saying for quite a while that, euro dollar, pound dollar, a lot of the dollar pairs were very extended and we needed to see a pullback. Not necessarily due to fundamentals, more just natural market movements. We needed to see some sort of a relaxation in price to allow buyers to come into the market. So I did decide to take a short position on euro dollar. Now, I'll be totally honest, this was quite a risky trade. So what the catalyst for this essentially was this level of quite a strong resistance through here at sort of the 1.11. Now, this was obviously, round numbers in trading are quite major. And we actually came up to, what was this, 1.12, almost to the dot. We came just slightly over. However, when we came to 1.12, we did see this exhaustion. So after we had this bearish candle, followed by another bearish candle, I entered on the third one when we came for a third push to the upside after 3 failures with wicks here. Decided to enter with quite a small lot size, really, just to test the waters. And since then, just had a pretty strong rally to the downside. And what I said played out pretty perfectly, really. So if we go ahead and look at the currency indexes, so we can see the dollar is bouncing off our support level really, really nicely. We've had pretty positive news for the dollar come out, which has helped sort of begin a potential pullback here. Now, I'm under the impression that we are still pretty oversold here. Let me just change the color of this fib. So yeah, we're pretty oversold, really. So since, when was this? June, we've come down, came down roughly 5.5%, give or take. It was 5.31, which isn't too bad. However, within this move to the downside, we had very little movements to the upside. We had very little opportunities for sellers to get in. Now, given the positive data that came out for the US this week, that could help support this idea of a pullback before we head into rate cuts for then a potential continued move to the downside. Wrong thing. So something like this. So maybe just a 50% retracement on the dollar before we head into sort of September with the, we've got the NFP coming as well next week, along with unemployment, which will be quite major. Investors will be paying quite heavy attention to those releases. So besides euro dollar, I also have a short on euro CAD. Now I've been speaking about this one quite a lot. I've been in since the start of August, actually, at this first entry up here. This trade was based on seasonality, along with a weaker eurozone, and the Canadian dollar was quite stable. So if you look at the euro CAD seasonality based from sort of October to the end of August, the start of September, then it's very, very bearish during that period. So all we needed to do was match the economics and make sure this trade was quite balanced. So the hourly time frame is now switched to a bearish trend, which is a nice sign. The daily's bearish, and the weekly is having a really, really strong bearish engulfing candle, which looks like it will close as it is, which is quite a nice sign. Although if you're not in this trade, I wouldn't suggest getting in, because I am looking to get out, possibly even at the end of the day. Maybe start closing out of some positions. So I've got quite a lot open. You can see I've got euro dollar, euro CAD. I'm also in copper, natural gas, I'm in gold, and I'm in the Swiss yen as well. So my portfolio is quite heavy. I also have some other longer term positions on the dollar yen and the Australian dollar as well. So yeah, looking to start flattening out some things. I'm quite overweighted at the moment. I'll go over some of the market suggestions shortly. Let me just see. Cool. Okay, so I've got roughly 40 minutes. So gold, I mean, gold's been a big topic. I put out a video on my channel about gold this morning, basically covering all the factors that I can see. So I won't go over them all right now. However, you know, gold is looking quite typical for an uptrend. We've had a really nice trend here. So obviously supporting trend line that's now no longer in use really. However, moved to the upside, hit resistance, quite a healthy pullback, continuation to the upside, and now we had another pullback in which I entered. So we had this really nice level of resistance. We had the fib level. So it was almost a perfect break and retest. In fact, it was a perfect break and retest. However, now we're stuck in this range. And to be perfectly honest, I don't really see this getting broken now. The only opportunity I saw was today with the news that came out, but it's not had much of an effect. So the only other catalyst I can see upcoming is NFP and unemployment. Or if there is some sort of tensions or some sort of spike in the geopolitical circles, but I don't really see that happening either, at least for the next week, maybe in the long term. But for now, I think pretty safe to say that gold may just stay in consolidation. So let me see, for anyone that is interested in gold, what I'm going to do is pull up some articles. So there's one here by TDS. I won't read all of these because they can get a bit monotonous, but just the headline here: visible short positions remain near decade lows. So that means that institutions, leveraged funds, basically COT data is suggesting that people just aren't looking to go short. And this is by TDS. So that it's TD Securities. It's an institution. So they know what they're talking about. It's not just some rubbish. We also have, yeah, that's about it. Actually, we've got heavy news next week, but for now it's pretty flat. I'm late for my fundamental lesson. Well, you know, it's funny actually. I was saying this morning on Twitter that I am not a mentor. I'm not an educator. I am a trader on social media. However, over the past sort of year or so, I've got a label of being an educator because the level of things that mainly people on this channel, so not just me, I'm not trying to sound big-headed here at all, but Trader Nick and the other guests, they put out content that is just vastly more advanced than what you'll see on Instagram and Twitter by the majority of gurus, because the education quality is just so low over there. It's all just fair value gaps, order blocks, 1 minute timeframes, all just nonsense. So euro yen, let's see. Yeah, euro yen, cool. So I've actually been quite inactive in the markets, really, in terms of looking at new assets and keeping up with the economics for other assets that I'm not already in. As I said, my portfolio is quite overweight at the moment. So more just sat on my hands waiting to get out rather than looking for new opportunities. However, Eurozone CPI came out this morning. I think it was CPI. Yes, it was CPI. Came out at 2.2. The forecast was 2.2. Previous was 2.6. So it's kind of expected. So we saw very little movement here on the euro. The yen, I'm still under the impression that we will see the yen get weaker over the long term. Now, the problem is, as we head into the rate cuts, we might see the yen start gaining some strength as we see a short-term move into safe haven assets. Now, that might not happen, but it's something that I am expecting, or something that I am prepared for. So I am kind of in the mind of this range in the yen will stay for now. And I hate to say that because I really don't want it to. However, obviously, it doesn't matter what I want. We need to be realistic. But over the long term, I more than see the yen start come down for a correction, at least sort of 50% move back down before we maybe see a move back up. Now, we haven't had sort of a full correction here on the yen yet. So if we look at the yen, it's in kind of a no man's land in terms of what's going on with the BOJ. Now, the MOF interventions aren't being sustained. This move we saw to the downside wasn't driven by interventions. The intervention was timed very, very well by the MOF in terms of it coincided very, very well with Bank of Japan hike, also a risk-off sentiment, and that initially caused an unwinding of carry trades. So the intervention was, well timed, but it wasn't what caused this move. So I'm not too bothered about interventions, to be honest. That's not really at the front of my mind. The main thing is hikes by the Bank of Japan. So I don't expect a hike for the rest of the year, which does support the lower yen move that I see coming. However, saying that, I do see the Bank of Japan hiking in 2025, and I see them doing it quite soon. So it might be sort of February to June is kind of the timeline I've got. So we'll see. But yeah, for now, to get back to your question, sorry, I kind of deviated there a little bit. I wouldn't be buying any of the yen pairs right now. I think, if you were looking to buy, down here was kind of the optimal price. And from here, this would have been sort of the only entry point. If you enter up here, you need a very large stop loss. So at least below this low, and that accounts for a potential intervention. And yeah, your stop loss would need to be sort of, if you really want to be optimistic, back at pre-intervention level, sort of a 157 or 175, sorry. But again, that's been quite optimistic. So the stop loss or risk reward here just isn't worth it unless you're willing to risk, 2 or 3% of your account, which I would never suggest to do. Dollar yen is the same thing. So I am in dollar yen longs here. So I got in down at this level I was talking about. The problem is the dollar yen just isn't seeing much momentum. We did initially see a really nice run to the upside, actually, which wasn't sustained. So since then, we've come back down very gradually, and now it looks like we might start heading up again. And that's driven by, quite positive US data we've had this week. Overall, let me just change that. There we go. So overall, I really need to see 152 on the dollar yen. And the reason is this is my average price. So I have two entries, one up here at 158 and another one here at 156. And then, of course, I've got one down here at 143. So the entries I've got to get out at break even, I need to see 152. And that's kind of it. I was trapped in this trade. I've spoken about a lot about being trapped in UJ. It was my own mistake. It was, one of those things that I just didn't manage this trade well enough. And it backfired on me, but that's fine. The risk I took on each position is more than managed. It's completely fine. But yeah, it's gone on for way too long. I just want to get out. The Australian dollar yen, same thing. I have an entry up here that I could close relatively break even. The P&L on this one is very minor. Don't really care about that one. So weaker dollar long term. I don't really see the dollar getting much weaker. I think we may see the dollar get weaker in the short term. In terms of the Fed cuts, I think we might see a slight move to the downside. So the way I currently see the dollar is we've got a 50 basis point cut priced in, essentially. So, that's what I've read from a lot of institutional reports, is that 50 basis points is already priced into the markets. So if we don't get 50, I could see us coming back up on the dollar, and that would be a lot of position closing and rebalancing. And then we start seeing a move to the downside on the dollar as we see the 25 basis point cut actually get priced and digested by the market. But that's just, that's more of a hunch. I can't say that for certain, obviously, unfortunately. But yeah, I think the dollar needs to see some sort of pullback. So I think maybe for the first half of next week, we might see a continuation of dollar bullishness. And as we start coming into NFP and unemployment, that's when we start seeing the dollar consolidate and potentially start moving to the downside. Thoughts on silver? Actually, I'll pull it up on this one. Let's see. Silver. I don't really trade silver, to be honest. It's not my favorite asset. I just don't see much going on here. You know, it doesn't really say much. You know, gold's hanging around all-time highs, silver's lagging behind. So, yeah, I mean, I suppose we've got quite a nice level of support through here on the daily time frame, and this is held quite nicely. But yeah, I just don't. There's nothing here that piques my interest, to be quite honest. My focus is fully on gold. So yeah, I will. Yeah, silver's kind of second best to gold, really, in my opinion. Excuse me. So yeah, in terms of gold, we can move back here. My plan for gold is two things. I either get stopped out at break even, so my position's break even, and I'm happy to leave it there. And the reason that it's break even is because it wouldn't shock me if we do see a profit taking dip on gold. And the reason I say that is because we've seen it previously. So if we look, you know, created all-time highs, had quite an aggressive move down, all-time highs, aggressive move down, all-time highs, aggressive move down. Now, we've not really seen that. We did have a move to the downside very slightly, but it wasn't anything too major. So we might see that as we come into next week and we approach NFP and unemployment. It might be a case of capital protection. We see some profit taking and gold come down lower. So in that case, I will likely be happy to buy, obviously depending on what NFP and unemployment tell us about Fed cuts, but more than likely I'll be buying gold again. And then the second situation is if gold rockets. Now, by 2,700, I want to be out of 50% of the position. Now, taking partials isn't something I do ever really. However, this position I am targeting 3,000, which is a large target. You know, it's not going to be hit anytime soon. So what I will happily do is take sort of 25% of profits or 20% profits, then another 20% trail stops quite aggressively and manage the trade very, very closely, rather than, you know, just trailing stops and letting it run. And that's just so I can secure profits along the way. If I'm planning to hold this trade for 6 months to a year, I don't want to just sit with a full position open. I'm quite happy to cut profits off and sort of trail it and slowly trim, if that makes sense. I'll admit, James, your financial analysis on currency pairs has on a streak winning. I see, yeah. Yeah, I mean, to be honest, fundamental analysis is actually pretty easy. And I say that in a sort of a mixed sense. It's not easy if you're new to it or you don't have any guidance. However, I do a lot of research on bank reports. I get a lot of insight done for me, essentially. I also work with a professional regulated trader. I've got a university graduate analyst on my team as well. So, it's not necessarily just me that's sat here talking to you. It's also the Elite Traders team and a lot of bank reports that is regurgitated and aggregated through me. So I can't take all the credit there. But, it is what it is. As long as you watch the right people, pay attention to the right things, there's no reason that you can't start winning in these markets, to be perfectly honest with you. So moving forwards, let me just double check time. So I've got, I'm fine for time for now. That's fine. So let's have a look at the Edge Finder. I was long actually on the pound Canadian this morning. Yesterday I was long on the pound Canadian. I think I deleted. Yeah, I did. Let's see, where was it? So the fib was here. Sorry, just having a. There we go. The fib was here. I need to change these back to black. So yeah, I went long roughly here. I think it was roughly off here. However, I decided to close it because there just wasn't enough momentum. So we saw the H4 candle close with quite a strong wick to the upside. And I don't know why. I can't explain it. And this is very difficult, actually, for anyone watching that is in mentorships or doing courses. There is parts of trading that's very discretional. This is a good example of discretion in my strategy. So my strategy is very systemized. It's always off a fib. It's always has to match up with structure. So for example, this fib was taken, we had quite a nice consolidation here. It was support throughout here. So the structure was there. The A1 edge finder data was there, but the discretional part comes in when I said, okay, I don't like the look of this candle, and I can't tell you what to look for here because it's just a feeling. And then, look what happened after that candle. So I closed this trade for very, very small profit. It was probably 0.01% profit. But yeah, if I was teaching someone how to trade, I can't really describe this other than, if we see a weakness in a candle, then maybe look to close. So yeah, just pay attention to that. If you are doing courses and things, make sure to just watch out for any discretion, because discretion can't be taught, unfortunately. It's more just through market experience. Sorry, did I miss a question? Tatinda? Sorry if I butchered your name. I'm really bad at pronouncing names. Hi, James. Can you answer my question above? Can you please give your opinion if the jobs report next week comes in higher than expected and Fed highlighted the time for rate cuts have come? What if they don't cut in September and opt to cut in November? That's a good question. So let's take a look, actually. Let me pull up the calendar for you guys here. So this is investing.com. So if we go to next week and look here. So investing.com already has the forecasts written out for us. Now, these might change. It is just a forecast, and this might not be right. Again, it is just a forecast. So don't take these numbers too seriously. So for NFP, I'll go over both of them. NFP, the way I view the NFP at the moment, now this again could be very wrong, so take this with a grain of salt, but this is just my view. If NFP comes in at 163, which it is forecasted to, or anywhere sort of 155 to 160 to sort of 165, that will be my signal to say the Fed is more than likely going to do a 25 basis point cut. And it'll more than likely be 3 cuts of 25. However, if we see NFP come in towards the 120 mark or anything around that, so maybe 114 again to 120, maybe 125, even 130, that still signals that the labor market is weak. And that could tell me that the Fed is more likely going to do an aggressive cut of 50. Same thing with unemployment. If unemployment comes in at sort of 4.2 to 4.5 or anything in that region up to 5%, then again, that will signal to me that we are more looking at a 50 basis point cut. Whereas if it's lower, so if it comes in at 4.2 to sort of 4.14, then it's going to be sort of a 25 basis point cut situation. And if these two contradict each other, if we get, I don't know, for example's sake, let's say we get 165 on NFP and then we get 4.5 on unemployment, then I don't know. we'll see. To be perfectly honest, I don't have every answer. I wish I did, but that's just my view at the moment. No reason to be buying that. I caught sells off the top, major supply rejection. Sure, Brendan, if that's the way you trade and you made some money, then congratulations. Yeah, as I said, bought it, didn't really like it, so closed out. I think I've lost it. Where's it gone? Edge Finder is quite bullish on it, so I follow the Edge Finder quite seriously, especially for day trading. So the way I use the Edge Finder, if anyone also has the Edge Finder and doesn't really know what to do with it, essentially there's 2 ways I use the Edge Finder. One is if we are looking for a short-term trade, like this one, for example, I was just looking for a small 1-to-1, 1-to-1.5 trade. I'll use the Edge Finder because it's got the current data. It's got what's happening in the economies right now. Whereas if I'm looking for a more long-term trade, let's say here I am looking to go long, But then we start seeing bearish candles, and the edge finder's bearish. But let's say, you know, bank reports are super bullish. Everything in the forecast is bullish. So everything that's coming into the currencies or economies looks bullish, but it currently isn't. Then I can say, okay, well, edge finder's bearish, but my forecast is bullish. Then I can wait and basically just wait for the edge finder to catch up, or wait for the current data to change. So then it might switch on edge finder to bullish. My forecast was bullish, trend is changing to bullish. I can say, okay, I'm going to buy here. So essentially, edge finder is a great way to find immediate trends, or to use, I know Nick says it's not a timing tool, but I use it as a timing tool, and that's because I have more of a long-term forecast in my analysis. But I know a lot of people don't do that, so you know, that's just my 2 cents. Some things you can only learn through time in the markets. Absolutely, I agree with that. So I could sit with you for 2 months and explain everything I know. However, you still won't get the same results because you don't have the same amount of time that I have, and the same sort of longer scope of things, or intuition, I should say. No reason to be buying that is strong word, since everybody's strategy is different and there are plenty of ways to trade. Yes, I also completely agree with that. 2 people can be in either side of the trade and still make money. Obviously, it's all dependent on strategy. James, the Fed cut with 25 basis points. Does that mean gold will not go as high since it needs 50 basis points in fear? Yes, essentially so. So if we see a 25 basis point cut, I don't see it really doing too much to gold. I think we might see potentially a new all-time high, and then sort of another consolidation. But yeah, I don't really expect much on gold if we do see a 25 basis point cut. As I said, cuts have already been priced in. So whatever you see, so let's say you now see, oh, the Fed's going to cut, again, just for example's sake, let's say it's 75 basis points. You're already behind. Institutions have already got that information, and they will already have begun pricing it in. So you're already behind the curve. So especially now, it's more than priced in. Large market players know or have an idea of what they want to see or what they expect to see. If they don't see it, they'll cut positions and potentially add new ones. So yeah, that's essentially it. So for example, again, just going back to example's sake, if the Fed doesn't cut, more than likely we'll start seeing this sorry, where's my pen gone here? More than likely see this get corrected, because this essentially is Fed cuts priced in. Now, of course, that's not just it. I'm simplifying it quite a lot, but you know, on the face value, that's essentially it. So just trying to think if there's anything else I need to cover. EuroCAD, yeah, EuroCAD's still moving quite nice to the downside. So I think I'm going to cut this position at the end of the day. We've had a really nice run on this. You know, I can't complain. Not looking to hold this one for too much longer. So yeah, actually almost a perfect trade, really, to be honest. It's one of those ones where I would execute exactly the same way if I went back in time. And that's how a lot of your trades should be, by the way. Dollar Swiss, we can cover dollar Swiss for sure. So, oh, you know what? That's good to see. On one of the previous streams, I can't remember, it was probably earlier this week, someone else asked for dollar Swiss. And I said, the only real buying place or buying level is off this support. And we've basically seen that. Although, you know, that's very basic technical analysis. I won't stroke my ego too much on that one. So as we've seen the dollar start to gain strength, of course, we've now in turn seen the dollar Swiss gain strength. So let's see. If you are bearish on this, which to be honest, you probably should be bearish, based on the technicals, the daily's bearish, the weekly, the hourly, and the H4 are bearish. And the dollar potentially is just having a correction. So we could be looking to short. at the 50% pullback. So something around here. Stop loss maybe here just to allow the 200 moving average to have space. And in this situation, you have two take profits. So, if you want to be sort of in and out relatively quick, just target the previous low, go for a 1 to 2. However, if you're a lot more bearish on the dollar, if you're expecting a 50 basis point cut, then you could maybe go down to the fib extension at 8.1 or sorry, 0.81 and go for sort of 1 to 4. Now, I'm not going to do that because I am actually quite happy with a bullish dollar. I'm short euro dollar, I'm long dollar yen. So that's fine. And obviously gold acts as quite a nice hedge for those positions, but that's the way I would approach this if you were looking to trade. Is there a special sale on your price? A few days to go, you give 50% discount. Is it possible to return the sale for a few more days? Jacob, we actually improved the 50% discount. So normally we price our Discord at $100 a month. Currently, you can get it for $10 for the first month. So if you, oh God, I can't remember the code. I think it's, hold on, let me find the code for you. And you can get that. So sorry guys, give me a second. Let me just stay on track here. I have a habit of going off track and rambling. So let me see what the chat's saying. Hello, James, your view on Euro New Zealand. I'll get to that in a second. Jules, James, do you talk on fundamentals on your channel? Yes, every Sunday I do a watch list. And I do update videos. So for example, the video I uploaded today on my channel was breaking down gold, going over some of the fundamentals, some of the news articles for gold. So yeah, feel free to go and check that out. Of course, it's completely free. I don't charge anything. Channel's not even monetized. So, I am a good Samaritan. There you go. That's the code. If you use that at checkout on the monthly package, you can get the first month for $10. Where do you see dollar yen going? Dollar yen, I would like to see it go to the upside, and it currently is. To be honest, I don't have high hopes for the dollar yen. And the reason is because it's very uncertain. With Fed cuts coming and uncertainty of when the Bank of Japan will cut rates, I expect it will be next year. However, it could be tomorrow, well, not tomorrow, but realistically, it can come at any time. Although I don't think it will. And that's, it's a big word, think. I don't think it will. I don't know. So to be honest, I actually missed my exit here, to be perfectly clear, transparent. I would, if we get back to this fib level, I would quite happily close out and realize a very small loss on dollar yen, to be honest. And the reason is because, yes, I see the dollar having some short-term bullishness, but in the long term, if we digest some Fed cuts, I don't really want to hold into NFP and unemployment and Fed cuts. It's just a bit too risky. None of these positions have stop losses because they were DCA trades, position trades. So yeah, it was one of these trades where I messed up. I'm quite happy to admit that, but it's managed. I've managed to recoup some of the loss with my open positions such as euro dollar, euro CAD, and gold. So it's not an issue. So yeah, realizing the loss here isn't a problem for me at all. But I definitely would not be looking to enter any yen positions right now. Someone also asked for Euro New Zealand. Sorry, I forgot. I'll go over that one now. Actually, Euro New Zealand, I think, if I'm looking at the right chart, is it? Or was I looking at? Yeah, no, it wasn't. So yeah, we'll go over Euro New Zealand. So essentially, a very similar thing as what I just popped up there. We had a really nice level of support here that was broken through and technically retested. Let's see. Actually, was this it wasn't quite a 50% pullback here, which is a bit unfortunate. However, we have the moving averages crossed. So the 200 and the 50 moving averages are crossed bearish. That tells me the trend is now to the downside. So yeah, I'd be quite happy to look for a short position here. In terms of the fib, I guess you could draw up sort of a zone here and use both of these highs. So I'd be looking sort of here. So within this level, would be sort of my selling zone. Ideally, we'd sort of come up to here. This would be perfect, really. Yeah, I'm quite bearish on the euro. That's why I'm in 2 short positions. New Zealand, I also don't really like the New Zealand, so that's why I'm not really bothered about missing this short position. I don't really like the New Zealand dollar. It's not something I trade very actively at all. But yeah, I would be quite happy to go short here. Well, sorry, not here, but I'd be quite happy to go short if we can see a pullback on Euro New Zealand. Similar thing actually with the Euro Australian. I was looking for shorts here off this level of support and a break of the neckline. However, typically missed it. I was watching this for at least 4 or 5 days, and when we finally got this break, I just wasn't there. I completely missed it, which is a bit unfortunate, but what can you do? Oiled up the gold, man. I'm not sure what you mean by that, to be perfectly honest, Raj. I'm sorry. USD CAD. I think I've got time possibly for USD CAD and Australia, New Zealand, and then I think the next guest will be coming on. Actually, let's see. Is the dollar giving back? No. Okay. So, actually, let me just change the delete that. Yeah. So, dollar CAD. Again, this is one I was very bearish on for quite a while. I think it was roughly sort of in this area, sort of around here. I was looking to go short, but we just never saw a pullback. So, of course, you should guess by now, but I really like fibs. And I was drawing fibs basically throughout this whole downtrend, trying to find an entry, and it just never happened, which was quite unfortunate because, I was looking to sell and you see it just dropping without you. And it's trading. But yeah, I would love to see a pullback to this level of support. This would be a really nice break and retest for a continuation to the downside. Target wise, I suppose you've got quite an optimistic target down here. If you are doing your own research and you're very bearish on the dollar CAD, you could more than happily target this previous low. It's been untested, so we could maybe come down and create a double bottom down here. Or if you're more conservative, you want to just follow the trend quite quickly, you could maybe go for sort of a 1 to 2 off of this and just trade it back down to the previous level. So it'd be basically resistance to support trading. So it was Australian dollar, New Zealand. Oh yes, okay. I was long Australian dollar, New Zealand, and my idea was very clearly quite wrong, actually. Now the Australian dollar is clearly losing quite a lot of momentum. And to be perfectly honest, I don't know why. I need to go and have a look and do some research on the Australian dollar. I might be a bit outdated on my bullish Australian dollar idea. But based on the technicals, if we can see a bearish candle close below the previous one, so engulf this bullish candle, I'd be quite happy to go in for a very short sort of intraday position to the next level of support and go for, at a push, a 1 to 2. Worst case, it'd be sort of a 1 to 1.5, so something like this. Remember, don't be an R&R goblin. Don't be one of those guys that has to have a 1 to 5 risk reward or whatever. It can really damage your long-term potential if you only take trades if you can see a huge R&R. Sometimes you can catch some great stuff just by going for 1 to 1.5s, 1 to 1s, 1 to 2s. Often you'll find the most consistency doing that. Obviously not speaking for everyone, but just from what I've found. Got 5 minutes left, so yeah, we can cover oil. I assume you mean crude oil, not Brent oil. So oil. Let's see actually if there's anything that's come out about oil. Let me just quickly have a look here. Where would we go? Reuters. Energy. So we need crude oil. Oil set for weekly gain on supply concerns. Oil prices face pressure from slow China demand and inventory. World stock, that's not related. Oil settles at 1% of worries from supply. It seems a bit mixed, to be quite honest, on Reuters. Let's see what CME is saying. By the way, guys, if you are not aware, all of these websites are free, apart from Bloomberg. You can use all these for commodity news. Feel free to take a screenshot or whatever, but it's always helpful to stay up to date with what bigger people in the markets are thinking and saying. So yeah, I don't really see much for oil at the moment, to be honest. It sounds quite bullish on the surface level of things, but yeah, there's not anything overwhelming that I'm seeing here. Oil price is largely unchanged, set for some August losses. Last thing, I'm going to show you one more thing before I go, and this is actually, let me pull this up. This is seasonality for oil. Now, I did a video on my channel not too long ago about looking to short oil, and it's this. So if we look at oil over the past 33 years, and we look at it from October the 13th until the start of December, so December the 10th, if you bought oil throughout this whole period for the past 33 years, you would have lost 23 trades and won 10. So if we flip that and we look to go short on oil between these periods, we would have won 23 and lost 10. So depending on the supply and demand, depending on China data and tensions in the Middle East, if we see some more bearish catalysts for oil, we could more than easily see quite a deep plunge, to be honest. So it's quite hard to mark that up because, again, just on seasonality, you can't really take trades. You need to have something to back it up. However, just going off that, let's say there is, hypothetically something there, and we do look to go short on oil. I would be quite happy to potentially target, I think, $40 a barrel is a bit excessive. I think maybe $60 a barrel, sort of in this region up here. Sort of around there would be okay to target. So yeah, I think that's kind of the only thing I've got on oil. In terms of what's going on with oil, it just doesn't seem like much. So I'm sorry, I can't really give you too much there. Next week, we have Bank of Canada interest rate decisions. They're expecting to cut for the third time, which are taking USD CAD. Bullish in that case. What do you think about oil? Appreciate it. I've just covered oil. Feel free to rewind a little bit and you'll see my coverage, but in a nutshell, nothing. Sometimes for markets, there is just nothing there. You can't, I don't want to go in there and say, oh, there's a support here, there's resistance. I'd start shorting there because I don't want to give you guys false ideas and bad ideas and things. I don't think that's fair. So I'd rather sit here and just be honest and say that I don't see anything there worth trading, to be honest. So yeah, I think let's see. Yeah, I might just cut my positions, to be honest. So euro dollar, I think I'm going to cut this one. Really good USD data this week. Quite nice profit here. Euro CAD, again, quite nice profit there. So yeah, I'll be closing out these two. Guys, okay, that is my time up for this segment. Let me just double check it actually is before I go. I've done it before where I leave too early. 9:15 to 10. Yeah, okay, that's cool. Okay, guys, I appreciate you all being here. You've been a great chat as always. I hope you all have a great weekend. And as we head into next week, don't forget we've got a really busy Friday, so don't place any positions you're not willing to take losses on, as always, of course. But we'll see quite a volatile week next week, I think. So yeah, that is it. Again, have a good day. I'll see you all later. Enjoy your weekends.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show.
Hey everybody, how we doing? Happy Friday. Welcome back. So just taking a look at a little bit of everything here. We got some wild price action happening right around this weekly VWAP on NQ, and I did look at MES and ES as well. So the S&P is way more indecisive at this top. I built out a bit of a new workspace here to simplify things. My charts are getting a little noisy, so I just did a cleaner and fresher from my original workspace, which was clean living charts. But now we're cleaner and fresher with pretty much nothing on my charts other than what I'm about to draw today. So we're still indecisive. We have 9 days of indecision here on the S&P. It wouldn't surprise me if today we have a little bit of upside potential towards the 563, 564 handle. Call option volume is still, strong to the upside for the morning. We still have some gaps to the downside in case this market's going to fail. But I do have some long positions this morning that I'm looking to see if I can just get right up to these highs. I'll take some quick profits on some SPY longs. I just want to see if we just come up to these levels, and then I would expect us to fall back in and kind of go nowhere for the day, but have just a little creepy climb to the upside, find the same highs as yesterday, not quite get to 565, which is the previous all-time high, and we'll just see if price just kind of fades off that move. So I'm long right now in the SPY, and take a look at the Qs as well. Qs to the upside, looking at 478. We've got a nice little play. Trying to get up into these levels. So we're trading at 476. So it's kind of split between, this is a 480 strike and like a 471 strike. See if we can get up here. We're trading at 476 right now.
Hey, Chris. We were listening in and we noticed.
Oh, I don't have a chart. Oh my gosh.
Your screen's
my
not
bad,
up.
dude. It's like I haven't been here all week, Chandler.
Yeah, well, we got to polish. We got to get the C legs back.
You can't see through the Ferris wheel?
I like looking at the carnival, but
all right. Cool. This is what I'm talking about. Thanks. All right. So looking at some strike levels here, and I just, similar to what we saw all week, I just see intraday highs, and we faded hard off of those. Intraday highs from the other day, we faded off of those. I could see almost the exact same thing, which is just we go a little bit higher, fade back down. So this morning, I just initially am looking to get long, and then this afternoon I look to see if we fade back down. So I am long the Qs, long the SPY right now, just in the interim to find some of these gamma squeeze levels to the upside. I'm going to respect yesterday's high. So if we get up another, maybe $1.50, I like those plays. So let me see here. 476. Let me put in. So QQQ. 476 and 477. Yep. All right. Hang on a second. And 477. Okay. Keeping an eye on those. And then back to the SPY. We're at 562 right now, and looking to see if just directionally we are going to try to find same high as yesterday, squeeze up into my little gamma levels, resistance zone, and then maybe come back and fill the gap by the end of the day. So overall, I see all the comments there. Can't see your charts yet. You got to shout that out earlier. So anyway, let's get this out of the way. This is what I see on the S&P. A lot of indecision. 1, 2, 3, 4, 5, 6, 7, 8, 9. Basically, from 10 candles back, that was our last kind of real decisional play. We haven't quite hit the all-time highs again in the SPY at 565. We're still showing some indecision. And as we head into September, the one thing we are going to have in September is a lot of news. We can go through Yahtzee. That trade just closed out for $50 a contract. That is hot diggity. That is a $50 win. And that is all around 10.05 profit hit at 10:05 a.m. Eastern time. Thank you very much, Ms. Lippy. I'll get that trade going. Any Billy Madison fans out there? Is that before your time? All right. So that was a little SPX trade that I took this morning. Now I'm going to look to see if my spies and Qs work out. I was discussing the news for September. I do want to take a look. Let's just go high impact only, and let's play a game of how important is the news over the next month, because we got through core PCE today. I think we're showing 2.6 right here, 2.62. If I zoom in over the last year, okay, so we have seen since January's read, okay, our core PCE has been lower, but notice this. We had a low and we are now sideways. So the same thing with CPI year over year. It's just sideways. It's sticky. And so we are going to have more inflation data coming in September. I want to look out for the month. Let's go September. All right, so here we go. For the month of September, let's highlight some things here. We have month-over-month CPI for Switzerland on the 3rd. We have U.S. PMI numbers coming out early. We have Aussie GDP. We have the Bank of Canada. As James said, they're expecting to cut again. Yep. So previous was 4.5, looking for a forecasted cut of 4.25 for the CAD. Okie dokie. By the way, this is a nice trade that I like this right now. Dollar CAD going into next week. I do have some longs on the dollar CAD. So I'm down $13, but I'm looking at some profit levels here based on my current trade size. This will get me about $160 or so on just on the current trade size, but I'm going to level into this thing here. So if I have trade 1, these are buy limits. So I'm having 1, 2, and 3, and I'm trying to get back to this pocket. You can see this really nicely on a 1-hour time frame. If I got any Forex traders out there, I do think this is a really nice trade. So this is one of my kind of favorite setups where things are getting a little bit oversold, and we have this glaring inefficiency right there. And so I took a small trade. If we test the lows, I'm going to add a second position, and I'm spacing this out for a third position at a round number around 3,400. So if this just goes up to fill my, actually, you know what? I'm going to move this a little bit. I'm going to move this up here. So that's 35.70. I'm going to go 35.65 right there. And I'm going to go 35.60 on this one there. And 35, let's go 55 right there. I'm just going to bump these up just a smidge. So I'm staggering these profit targets where, you know, these levels get hit and it's really just coming back into this pocket. So to me, I see this as an inefficiency. I like how we've sold off all the way from those tops around 3,900. I just patiently waited. I mean, we dropped, 500 pips roughly. And I think now with CAD, CAD news next week, it's not necessarily about they cut, they don't cut. I mean, sure, if they cut, it would make sense that the CAD gets weaker and the dollar gets a little bit more resiliency in this trade in particular. But I just want to see if we just come back and fill the pocket. So it's just an efficiency trade. Once this hits, if it's only one entry that hits profit, then I'm canceling those two trades. If we see some volatility and chop, which will kind of be better for me. If we see a spike down and all of a sudden I get taken in a couple of orders, but then we end up coming back up to that candle and efficiency anyway, then I get a couple more trades added in. This trade size gets up to about $3 a pip and rallies up maybe $100 or 100 pips or so. So it go from about $150 profit to maybe $300, $350 profit, give or take. So that actually is a pretty good setup in my opinion. I like that. I like the dollar CAD trade quite a bit. Let's get some other charts here. So S&P indecisive, and I think it's going to stay that way. Go back to the news. What else we have? Joel's job openings on Wednesday. We're coming into a non-farm payroll week, so we are going to have ADP on Thursday. Usually it's Wednesday, but because of the holiday, they shifted it. So we have ADP non-farm Thursday morning, unemployment claims Thursday morning, PMI numbers again on Thursday. So U.S. news is going to be pretty solid next week, and CAD plus dollar, or US and Canada employment news or non-farm, forecasting 163. I think one good thing for the US economy would be if number one, we beat this expectation, and two, we have a positive revision. Because that 114 was a whiff, right? That was the one that forecasted. If we go into the graph on that non-farm, let me zoom in. Hang on a second. Just zoom in here. There. So the forecast was like 160K. We came in 114. So we're going to see if that revision is going to be an improvement. If it is, that's probably some good news for the US. That might keep some stability in the markets. I mean, and we go back to price. I mean, I'm just going to compare this to where I think the SPY can go. Now, let me ask everyone a question out there. Do you think that a break to these all-time highs is going to keep going through the month of September? Yes or no? How many of you think that we hit 600 before we hit, let's say, 540? Those are my two levels. So I think I asked this question last week, and I said, are we hitting 600 first, or are we hitting 500 first? And now I'm asking, I'm gonna take out 500 for a moment and see, do we hit 540 first, or do we hit 600 first? Because to me, if we were to hit 600 before we hit 540, I'm turning a little bit more bearish up here for a decent correction back into these previous highs. Not necessarily by the end of the year, but something tells me that we'd have like a rough Q4 or like a terrible December January combo. I would see a healthier market. To me, a healthier bull market if we pull back first and we can find this 540 zone, then we can justify higher highs and we can make a nice little end of year run to 600. To me, that's healthy. Okay, this would also be a really nice bullish pattern where we have. It's funny how this it's a trend line and we just broke the trend line. You can't look at it like that with an instrument that is built to go up. So now I look at this area as, okay, is this just creeping up to give us a head and shoulders? If so, right shoulder area, look for some price accumulation in here, and then we get to these highs. Once we break, this actually could be a really easy thing to measure by the end of the year. Let's say that from this low to high, we do in fact come back down to 540. Okay, if we come back into this 540 zone, see what I'm doing there? I'm just taking this swing, and I'm just gonna say we're stalling at these highs. Okay, so if we stall at these current highs, and we come back in to find this 540 support, then I can roughly drag this over here and say that's going to be the measured move. I'll make this a little bit wider. That's going to be the measured move. Okay, so if we come back down and find this low right around this 537 to 540 zone, that symmetry puts us up to 590. And a 600 is a nice round number, but guess what? If we get a chance to buy or participate here for a bull trend and we get up to 590, that is a perfect spot to be trapping, trailing. If we get to 600, consider that the extra gravy on top, but I would be looking for some type of pullback with that kind of impulsive measure in that symmetry swing. Okay. So that's what I'm looking at right now. S&P, you can do the same type of thing on the NASDAQ. Here are the Qs. Okay, the Qs look a lot different, obviously, because this high to low did a little bit more damage. I could see the same thing where you have to use this July 31st high to maybe be this swing. So we have this trade. We broke this trend line. We have a left tip or a little bit of a crown structure. So if we're going left structure, center, we keep pulling back a little bit in here. The Qs, I'd be looking for 460 or so. 460 to 455, that support zone. And then I'd look to see if the Qs can get back up to the same highs. If they go higher, great. But I'll be measuring that swing. So let's take this swing right here. Okay, let's say we pull back into this like 555 zone, or I'm sorry, 455 zone. So take this out a little bit wider, pull back into this area, and that's going to project us up to around 517. So I can mark these up later. I'm going to try to do my best when I come on these sessions to keep my charts a little bit cleaner. I can see through all that stuff, but look, I've seen some crazy stuff out there when people are, in Discords, like sharing their charts and sharing their indicators. Some things are just wild and crazy. And I get it. Like, it's easy to have like, oh, these are my top 5 or my top 10 indicators. All sorts of stuff can be on the charts. And when you do it every day, you can see through that. But to just the normal observer, it's like, what is that nonsense on your chart? So I'm just doing straight price action for right now to keep this a little bit cleaner. Okay, so that's my cues. If I'm going the Dow, we've hit some fresh highs on the Dow. We've actually had several without having the S&P and the NASDAQ make some fresh highs. So we have 1, 2 all-time highs again. Structure-wise on the DIA, I don't know if this needs a pullback first. I look at this area as, okay, we're making some higher lows. We're making some higher highs. I don't think this necessarily blows the top off, but instead, maybe just a little indecision, maybe some steady pullbacks, but some opportunities to buy and then stretch back up to all-time highs by the end of the year. We might deal with some indecision on the Dow. We'd have to for me to be bearish on the Dow, we just have to break structure. I'm not saying like that's all, but there's no reason I'd be bearish on this one if we're still making higher lows for right now. Okay. And then for the Russell's trading at 219. I do have some trades that expire today for credit if we stay above 2100, which I'm assuming that they will. If we do that, great. If it comes back to 2100, that's like a 5% drop. That's going to be rare. But if it does happen, I've got a profit trap waiting. So most likely I'll just keep my $1.15 per contract credit on the RUT. And then also I've got some long positions on RTY. VIX is faded off of that like $17, $18 zone. I'll go to the VIX here in just a moment. But for the Russell, there's still about 11.5% upside to get to this high. We are still sitting here making higher lows for right now. Okay. And for me to get bearish on the Russell, I get it. Like this is an attractive all-time high. This is the one index that hasn't quite gotten there yet. So can we see this low to high with a little bit of accumulation and then see this actually make a break for it, make that swing push into all-time highs? If we hit 240, 245, I like that trade for some profit. The way that I'm trading this, I own the shares around $200. Right now they're covered up to 225. Okay. And if that gets called away, I'm probably just going to get it called away. That's $25 a share. And I've lowered the cost basis with some covered calls. So I'll probably end up netting my break even is probably closer to like 192 than it is 200. So I own the shares at 200, but I've lowered it with some options. So if I own the Russell around 192, I don't mind it getting called away at 225. And then the other trades I have a 240 by 270 bull put spread and a 245 by 270 bull put spread. So these are out of the money. They didn't cost me a lot. I think I paid maybe a combo of like $7 for the two of them for upwards of, I don't think 270 is really attainable, but if we go to, $15, if we go to $20+ credit, that would be worth the trade if we get to those all-time highs. So I'm going to keep an eye on that one. VIX, like I said, we are retreating still. I do wonder if we're now operating in a slightly higher volatility space. 15 to 20 is considered medium volatility. If we have a bit of a sell-off in September, do we get higher than this 20? Do we stay at 15 to 20 and just kind of oscillate in here? Do we have a little bit more of a vol event that gets us back into the low to mid 20s? Term structure on the VIX is pointing towards like the high teens, so 17 to 18. That will continue to see, time decay, which is good for my SPXY position. But if this flips and goes the other way where it starts to look this way for term structure, that means we're likely going to see higher and higher volatility until things settle down. So for right now, it looks like everything is okay and stable. But going back to that calendar, once we get through next week, which is pretty decent US data, we're coming off, so no trading on Monday with the banks being closed. Wall Street will be closed as well for Labor Day. But PMI numbers next week, JOLTS jobs opening plus unemployment claims plus ADP plus non-farm all coming next week. If the market's sensitive to employment data next week, it's going to have to see that there will be some more decisions to be made. There's going to be some interest in like, okay, this is good news, bad news is bad news type thing. And we'll see how the market's anticipating the SOM rule. The one thing we've also been looking at this week is the 10 and the 2 year. The 10 and the 2 year, if you're watching the yields, that inverted yield curve is much, much, much closer to getting out of this inversion. We're now about 4 basis points away. I think this week we were as close as 2, and we're right back to getting really close. And I think the one I want to watch as well, let me put in a US 30 year, because the 3-month and the 30 year also has some pretty nasty. Let me see if I can. I want to get a chart comparing like the 3-month and the 30 year with the stock market, because when they've come out of inversion, they've also triggered some pretty nasty market action as well. So let me see it. Let me actually get the 30-year on here. So let me go add. Let's add to my workspace. Let's go US 30-year. Okay, and then add this here. So I've got my 3-month and my 30-year, and we're still inverted by quite a bit. But I do want to watch that cross and correlation. Okay, back to the news really quickly. So we get through next week, which is heavy U.S. data, get through non-farm payroll. I think something that would help stabilize the market, in truth, would be that we have a decent farm payroll with a revision upwards. So instead of having that big miss, we have a revision upwards. Unemployment rate, the market probably doesn't want to see that tick any higher. Okay, average earnings, market probably doesn't want to see that tick too much lower. We go into the following week. Let's go September. I'm not sure why there's nothing on Monday 9th, the 9th, but it's just maybe it's just a no high impact day. We have a CPI and PPI combo on the 11th and 12th. So right into bank holiday, CPI for Canada, retail sales for the US. And then we're coming into the all important FOMC, CPI for UK, employment for Aussie, pound. Okay, so let's look at the week of the FOMC. So we get through PMI numbers, job numbers, non-farm on Friday next week. The week after that, we have CPI, PPI. We have the euro rate decision on the 12th. We also go into that next week. The week of FOMC, what I see here, we have a Bank of England rate decision. We have a Bank of Japan rate decision. Is that it? So we have, is that it? We have European, we have ECB the week before. So this, what's the trading week here? Monday the 9th through the 13th, we have ECB, right? Okay. Then we come into the 16th through the 20th, we have Fed, we have Bank of England, we have Bank of Japan, and then to finish out the month, we have RBA on the 24th, we have Swiss National Bank on the 26th. So that is, I mean, that's almost all of them, right? Swiss National Bank, RBA, Bank of England, Fed, Bank of Japan, and the Euro. That's 6 central banks in 2 weeks. That's a lot. So September is going to be a pretty volatile period, to say the least, which is kind of good. I mean, I don't mind having volatility. I don't mind having direction. But the question is, this is why I asked, are we going to 600 on the SPY, or are we dropping back down to 540? Because something tells me that, yes, there's going to be cuts. Is that going to get the market excited enough to continue to go higher? Or is it, these are highly anticipated. This is a buy the rumor, sell the news. Is all this stuff already priced in? Now that we're here officially getting those cuts, is it going to be fading, fading that news and seeing things dip lower? Okay. Lazarus asking Euro New Zealand. I'll take a look at that one. Sure. Russ says yen weakened today with normal U.S. data. I don't think the yen had anything to do with U.S. data. I think the yen was weak because we had the Nikkei still ripping higher. The Nikkei 225, it just continues to print green. This is another chart that I think we need to keep an eye on. If this goes straight up, this is like one of the dumbest, craziest, nastiest things to happen. Where we have, you talk about a V bottom. How about a 17.5% sell-off that comes right back to it? And there's been nothing but pauses in here. We haven't even had a pullback. So if all this is from this low to this current high, and I could see a little indecision here on the Nikkei before trying to justify going higher. But similar to what I'm looking at on the S&P and the Qs, I mean, ripping the way that it did here, I would like to see maybe just a pause or a pullback before the market can get itself back up to all-time highs. I mean, if it does this straight up, then I hate the Nikkei as much as I hate the Japanese yen. Because how are you supposed to trade that? I mean, I guess if you're waiting here to buy resistance becoming support, you got filled on a flash crash essentially, or a crash. But other than that, it's like, how do you buy that? I guess you just have to buy the breakout. So I'm kind of hoping that things kind of stabilize in here. But as the Nikkei is going up, expect the Japanese yen to continue to get weaker. Okay. Ryan says, you think recession for who? For the U.S.? I mean, yes, but how many of you know that a recession does not necessarily mean bear market? You know that, right? Like it's like 50-50. We can have a US recession, but the stock market can still go higher about 50% of the time. It's happened. Now, we also have the inverted yield curve, which ends up being a recession. We've got the SOM rule that ends up being a recession. We've got, a debt bubble that maybe is bigger, and like a fiscal crisis that's bigger. The one thing we also need to watch and see, like, how bad do things get? This is an easy instrument to watch here. If this ticker here, JNK, this is high yield bond spreads. If this ticker keeps showing two things, if it keeps this is stupid how this is going higher. But see how this is going sideways? Okay. This means that credit spreads are pretty tight. That's a good thing. Okay. When things come unwound, look at how much more volatile there was back in 2022. Okay. Look at how much more volatile there was back here in here. I mean, obviously the crisis we saw in COVID, just everything come unwound. So if we see this like have a sharp drop, okay, we did have a sharp drop August 5th, but it picked right back up where it left off. So credit spreads are still pretty darn tight. We're not really breaking any massive structure, but if there's a big fat drop to this thing and it starts to head lower, then I'd be more worried, because then we'd be talking like credit issues, credit crisis. That's when things get a little bit wilder and crazier and way more volatile, and not in a good way, right? Like, look out below. Things are falling apart. Things are things are already cracked, right? There's a lot of drama happening out there. A lot of things are bubbling under the hood, which nobody really wants to take a look at and acknowledge that we've got some real problems on the horizon. But the stock market, is not truly reflecting the economy. We know that. We saw that. The clearest example would be 2020. But the reality is, this has been kicked down the road so many times and will continue to get kicked down the road until it can't. And I don't know how long that's going to last, and neither do you. And as John Maynard Keynes said famously, the markets can remain irrational longer than traders can remain solvent. So as this debt keeps getting kicked down the road, I mean, the US GDP ratio is like 120%. Ray Dalio's got a whole campaign around that, talking about this world-changing order, the changing world order, and how terrible it is historically for all these regimes. I get it, but the can get kicked down the road, right? I have seen some very aggressive bears since 2019, since 2018, since COVID happened in 2020. They're like, see, I told you. But what happened in 2020? We kicked the can down the road again. And here we are talking about it 4 years later at all-time highs. So the stock market doesn't reflect the real economy. If you want to see things get really ugly really quickly, you got to watch this. JNK, if this thing goes crazy down and starts to show that credit spreads are widening from like triple A's and triple B's and triple C's, that widening credit spread means that it's harder and harder to get the liquidity that you want for these investments. And so high yield investments, riskier bets, are going to be deleveraged and probably getting, losses will be taken. So that's when things kind of perpetually get worse and worse, and they do it really fast. So I think that is the hard part, is like right now the markets move like speed chess. It is very much the cycles are faster. The downsides are faster. The upsides are faster. I mean, the V bottom that we just saw in the markets here, this is, I'm not going to say that it's never happened, but this honestly feels a lot like freaking COVID. I mean, from this period here, this wasn't even a month. COVID was like this perfect 30-day cycle from February expiration to March expiration. We were down here and we were up here. It was crazy how that happened. Or maybe that's not accurate. Maybe it was more like we were down here and then we were up here within a couple, it was like 2 to 4 months later. But it was fast. This was faster, right? So I don't know what the right answer is, but I'm staring at the chart. I'm watching price action just like all of you. What I'll be paying the closest attention to is if we break this low, I'm looking for this to head back into to 540 or so. That to me is a healthy spot for the bulls to then step back in and see if there's a reason to justify all-time highs. By the time we get through September is usually historically bearish. By the time we get through September, how bad is it? I would be way more skeptical if we're through September at higher highs. I really would be. And again, there's two ways this plays out. If we are through September with higher highs, then this is either the blow off capitulation move that is a freaking bubble waiting to happen, or we blow off. If we get through September higher, I don't think that we finish the year on a positive note. That's my opinion. So if I were to make a bit of a forecast, I would say that for right now, if we have September pull back, I look at that as a good thing to possibly get us into all-time highs by the end of the year and have a nice little Q4, a nice little Q1. Things should be good. We have a chance to get some more gains to the upside. But if we are going to blow off these tops, if we're going to blow off these tops, okay, I would expect either one, this party keeps going and it's like the dumbest capitulation move that bubbles up and we crash hard, or we have a rough finish to the year and maybe carry this into, reality, like, hey, it's a recession. Hey, things are awful. Hey, our, price to earnings on the S&P is crazy high, right? We get to those like high valuations, not going to be great. Okay. Keith, what's up, man? Back from your stress test? All good. There you go. Yeah, man, you got to keep that. You got to keep that. Look, you got to trade like Chuck Norris. You got to keep that resting heart rate at like 50 beats a minute. That probably changes. I just heard something on Sirius XM with Chuck Norris. He's got some supplement out there to like roundhouse kick your health into gear. Like, who the heck knows what that's going to be filled with? Who knows? That'll be filled with Chuck Norris's beer juice. Anyway, this is what happens when you're just here talking to yourself. Sometimes you got to entertain yourself. All right. Any other charts? I saw Euro New Zealand come in earlier. Take a look at that one. This is really I just missed this trade. I was 6 pips off the swing. Obviously a little bummed by that. I canceled my trades because once we had, I was right here for a sell trade and I missed that by 6 pips. That is disappointing. I should have been in a little bit more aggressively starting there, but it wasn't. But anyway, now that this has gone lower and we're coming back into this area, there's still some room to drift back down to these levels. I kind of like getting long Euro New Zealand around 75. But let me take a look at the daily time frame. Okay, it would make sense to me that we get to this low. Just look left, right? So who asked me about Euro New Zealand? And I got to ask you, what are you doing with it right now? Because if you're asking me Euro New Zealand, this thing is clearly down. There's more room to fall. Right? So 74 is the next level of support. So I wouldn't be forcing any buy trades. If you're a dollar cost average trader in Forex, 70, maybe 75, 74.50, 74. I like that zone to kind of start building, but building very small because that would be a logical spot. Right now, there's plenty of space to fall. There's still another, almost 300 pips to fall to these lows. And so if we have any pullback here, I think that looks good to continue to fall. So if we have a pullback, I'm looking to keep selling the Euro New Zealand. If we just keep falling, we hit 74, then sure. I admit that we could probably, buy from there for a few hundred pips on a bounce. Fair? All right. Aussie New Zealand, one of my favorites. I'm actually happy to see this one falling. I truly don't care about this currency pair unless it comes back to like 106. So right now it looks like we are turning. We are noticing that the RBA is probably going to be cutting. The New Zealand dollar cut to 5.25, but their cash is, or their official cash rate is slightly higher. It'd be 5.25 favoring the New Zealand to a potential 4.1 if the RBA cuts by 25 basis points. So if the RBA cuts, then we're looking to see if this one wants to head down towards maybe 106, maybe 105. If we get down to that zone, I'm probably going to buy it. I'll start small. I'll buy 106, 105, and probably 104, 103. I'll build small and I'll stay long. I'm willing to take that all the way down to parity. Call me crazy, but I've done it before. I trade really small and I'll just build and I'll just compound, a run that gets all the way back up into like 108 or 110. So I'd like to see, since we kind of broke that structure there, I'd like to see this continue to fall. So if you're in Aussie New Zealand shorter term than what I'm talking about, let me use a straight line here. If you're in the Aussie New Zealand shorter than what I'm talking about, shorter term rather, then a break, a retest, more to go. There you go. Something like that. Looking to come in and challenge those lows around 106 or 105. If it holds, I could see a bullish pattern forming there. And then we head back up into the same highs. And this is a range, right? This is a great range. If we trade from 105 to 110, 111, that's a great trade, because if we bounce off this support with a pattern, that's a great swing trade for good upside with a pretty easy stop loss. So I like that trade. Not too shabby. Okay, questions on that? All right. Roundhouse kick to my health. That's what that's all Chuck Norris is, right? My favorite Chuck Norris joke is beneath Chuck Norris's beard, there's not a chin. There's only another fist. That's my favorite Chuck Norris joke. All right. What are the charts? What are we in? We want to talk currencies. We want to talk indexes. We're still like sloppily at this VWAP level. S&P, I just took some profit. I'm expecting it to be pretty quiet as we head into a holiday weekend. I would be surprised if we see a lot of direction today. I'm just seeing indecision, which isn't a surprise. It's good for me. Sell the options, make some profit, and then next week, Tuesday, we'll kick it off again and see if we have some more news to spike up some spurs and volatility. I just missed that news. I don't know. See what that was. What'd that say? This approach, stock gains. Do they really gain? Are we up? We're going to be celebrating. I guess it's because we gapped higher. There's your gain, but price really hasn't gone anywhere. I trade currencies and I don't have CFDs because I'm a U.S. trader, but you can trade currencies. Yeah, if you're a non-U.S. trader, you can absolutely trade currencies and CFDs on the same account. So I trade stocks, options, ETF, futures. I trade options on everything. I trade crypto. I trade Forex. So yeah, I'm trading pretty much everything. But through a handful of a few brokers. Tasty Trade is a big broker of mine that I work with. I have a Tasty Trade. I've got what else? I still have a Schwab account. I still have a Schwab account with it. I use Thinkorswim. I use their Schwab platform on my phone. I have IG or Tasty FX for some of my Forex trades. I still have a couple of Oanda accounts that run some robots. So I'm all over the place. Fear and greed index making me think more upside. Yeah, that's possible. But I mean, remember that it doesn't take much to. I mean, I would say more upside if we break these lows. Who's asking that? Ryan saying that? I mean, if we break these lows again, then yeah, there's more upside if we break the lows. But if we stay here, kind of slightly elevated between maybe 15 and 20, this is going to be an interesting spot because we could have a lot of uncertainty and just more indecision in the market. I wouldn't be surprised with having one of the historically largest spikes up and the historically largest crush down, that this market doesn't just go straight down to the lows of volatility. I could see, I mean, just look at what we looked at in September. There's a lot of news. There's a lot for the market to digest, good or bad. I mean, I do think that the U.S. is kind of like the Fed and the U.S. economy right now. Their backs against the wall. I mean, I get it. Like Warren Buffett says, don't bet against the U.S. And I get there's resiliency, and it's the stock market, which doesn't necessarily mean the real economy. Recessions don't mean the market has to go down. All these things are true. But right now, news has investors' attention every single print. Because if we miss with all the employment data rolled into a week like next week, where we have ADP plus on unemployment claims plus non-farm payroll, if we miss and all of a sudden it's like a big whiff, I think the market's going to hate it, and I think the market's going to move on that. So I could see volatility, staying somewhat elevated between like 15 and 18. Obviously, if we start to poke above 20, things get a little bit more interesting. What would be wild and crazy would be, if we get back into the 20s and 30s and it would deal with this type of volatility like we saw in 2022, because that was a bear market, right? This vol spike, that Volmageddon that we saw on August 5th, like that rarely happens. But you go back to what a bear market looks like. Look at what a bear market looks like. Okay. This is a bear market. Our highest print on the VIX was still less than 40. But you can see that we had lots of elevated volatility the entire year, right? So different environment, price, as this is happening, we just had healthy bear market. 28 to 38% declines, 28% in the S&P, 38% in the NASDAQ. That's what our volatility index did. So this was more the 2017, this is like the playbook from 2017, which was crazy low volatility, and we had another. And again, I wish people would stop just making strategies on selling volatility, because that's such a stupid thing, and that happens. That's what happened in 2017. It's like everyone that's stuck, it's called Volmageddon for a reason, and it's a vol crush, and it's super disruptive. But if we go back down to these levels, Ryan's right. Like, we go down on the VIX, then yeah, we're going to go higher on the indexes. But with all the news that the market has to digest, I wouldn't be surprised if we're a little bit more elevated here, or maybe even starting to get. If the market starts to tip over a little bit, we'll probably get into the high teens, maybe low 20s again. These little spikes up here, they spike up into the 20s. Nobody really pays attention to it, because it's just like, okay, finally we have a little volatility relief. But anyway, all right. Nimi, would you like to ask me again? Ask me one more time for the pound dollar. One more time, and then I'll do it. Just kidding. I see your comment, dude. All right. I sold the pound dollar this week. I took a stab. I mean, it's mainly for the dollar. DXY. Okay. I'm buying the dollar right now in the near term. There's two things here. I don't think it's going to be that difficult to assess, right? It's like we have major support here and we have major resistance here. The dollar's been trending down for most of the summer. I mean, this peak started back in April, May of this year. So, April, May of this year, and a lower high in July. So the dollar's been trending heavy since July. Excuse me. Coming down to this major support, this to me was a fake out as we tested 100. We saw a holiday pivot and maybe a summer. Look, August is usually a transition month. So if this is a pivot, there is, and this is probably what nobody wants to see, there is a chance that this dollar gets stronger for the next 3 to 6 months. It happened here. It happened here. Okay. Now, I don't necessarily think for the stock market to go to all-time highs, I don't think this can happen. If we're going to see higher highs in the stock market, I don't think the dollar can do this. All right. So it's kind of two scenarios here, right? This is either sideways the entire time, and this is going to be, forming a bottoming pattern, or maybe it's already forming a bottoming pattern. Oops, let me get these lines here. There. So we are either, heading up, pausing, and then heading higher. And if we get back to the midpoint, that would make some sense to me. But the other spot that I'm watching is if this is a wedge. And this is why I don't love wedges, because it looks like, oh my gosh, the dollar broke out. It's going to go crazy bearish. And then this wedge here. This analysis is awful if all this does is go back up into the midpoint and back up into the range. This wedge is useless, right? So it looks good in theory, but this might not be the analysis at all. So I tend to operate more with kind of, I trust the horizontal levels a little bit more so than the wedges and the trend lines, because this could just be a low that goes all the way back up to the range highs. But the reason I'm looking at this as a potential bearish move on the dollar is this high to low swing that is pulled back to this level here. If we're going to see a weaker dollar move, and this is just the start of it, and all we're going to get here is a pullback, if the bears can take this thing lower, then that's how I think the stock market and gold and Bitcoin and everything against the dollar runs pretty hard. I think the dollar has to get weaker for everything else to gain. If the dollar is here, I don't see it being as good to the upside for everything else. I think gold pulls back. And of course, I don't know, right? I mean, I think right now the Fed is looking to be cutting. I think the Fed wants to see good data, consistency. I don't think they want anything super disruptive. The Fed has pivoted off of like heavy focus on inflation to now heavy focus on employment. So yeah, I mean, there's mandates that the Fed is now paying closer attention to, and that scale has tipped favoring employment more so than inflation. But I hope the Fed's still watching inflation, because we have not been impressed with the stickiness of CPI year over year, because it really hasn't changed much. We are at the same level with about a 0.5% difference between 2.8, 2.9, and 3.3, 3.4 for the last 12 months. We haven't seen really great trends to the downside outside of, well, the economy slowed down enough, people finally started to cut things back, and maybe the slowdown is happening, but inflation could still be really sticky. And so for the Fed to say as definitively as Jackson Hole was for Powell, I mean, he literally came on, the first headline I read on Financial Juice was, it's time for a policy adjustment, or it's time for a policy change. I mean, if he led with that, it's like, that is the most definitive statement that he said in months. So employment's a bigger deal right now than inflation. But I still think inflation matters to the point of they have to see it trend lower. We can't finance debt and potentially have that second wave of inflation that's going to crush everything. If we have inflation that gets up into 4, 5, 6% year-over-year CPI, US is going to be in some trouble. And it might never get back to 9%, but man, it's gonna feel way worse than what it actually is, and the market's gonna hate it. So, does your option strategy work better in higher, lower? ZA, I have option strategies for everything. I mean, lower volatility options, I tend to favor. I tend to do a lot of like calendar spreads and diagonal spreads if I'm doing low volatility, because what I'll do is I will buy something longer term and then sell against it. I did that this week I did a trade on JD this week. So I bought let me see what the prices were. I think I bought like a $13. And on the indexes, I mean, it depends. I mean, the indexes, I will do a lot of like back and forth. I trade the indexes quite a bit. And so I have for this week, I mean, we didn't really see a lot of volatility. I'm going to take a small loss on the SPY this week because we've pretty much gone nowhere. Let me check here. SPY. I know I have some hedges that are going to be unprofitable. SPX is fine for profit today. SPY. So I have a volatility play for next week. 1, 2, 3, 4. And right now it's trading at 637. I paid $8.50 for it. So I'm down a couple bucks on this one. But given the news and coming out of the holiday, if the market comes swinging for a fresh month, I just need to see if price wants to go somewhere. So basically what I did was I bought the 564 call and I bought the 562 put, and I'm looking to see if we go up one way or the other for me to grab some profit. So I need to see, I mean, I'm looking for about we have a $14 average. We have a $14 average on the S&P, and we haven't moved out of a $7 or $8 range in almost 2 weeks of trading. So I would expect a vol spike coming into next week. Either we poke the highs or we break and poke the lows, and we'll see where the market goes. So in a low vol environment, I tend to favor, I like buying options, but selling against them to tighten up my costs. In a higher volatility environment, I'm trying to stay way out of the way and collect as much premium as I can. Case in point, like with NVIDIA. When NVIDIA was dropping, I was selling way out of the money puts and doing some ratio spreads, where right now it's like if I took ownership of NVIDIA, it would be $75 and $65, which is way below price. And if I don't get assigned, I'm going to make like a couple $1,000s on just hanging on to this and never getting assigned. That makes sense? So I'm trading both. So there's not really one is better than the other. I also like trades where if I set up some type of asymmetry, let's say that type of price or this type of price. I like trades like that where I have low risk and I have a profit trap opportunity. So even if I find this trade and I trade this for maybe 50 cents. Well, if this can pay me like $1, $2, $3, maybe $5 at the peak, I mean, that type of asymmetry gives me some really nice gains over the course of months and months of trading. It's like all I need to hit is a couple of these, and I get these like 2x, 3x returns, maybe a 10x return. Like you get a couple of those sprinkled in over a month or a quarter. It's really easy to have super low risk and then get some nice injections. Okay, does that help? Okay, and then I see. Oh man, I saw Nimi get kicked. He was either talking trash or he's still asking me about the pound dollar. Not sure. Ryan says Powell is right. The unemployment rate is low, but I think it's positioned for a rise. Look, I don't have this on my computer, but let me see if I can go back here. I take so many screenshots of these podcasts I listen to. Let me see if I can find it. I followed this guy for a long time. Weiss Capital Management, Jordy Visser is this guy's name. He is like a Bloomberg savant. I mean, I've seen this guy pull up correlations and things that I never thought about. Let me see if I can find his. He had a pretty good look at like recession, rotation. Let me see if I can find his webinar that I was in. So we saw some rotation into staples and real estate, utilities. Let's see. But by historical levels, total existing home sales, we have the year-over-year index. I mean, the S&P price hasn't really reflected anything down to the downside. Housing affordability is terrible. Consumer sentiment's actually quite low still. I'm just looking at I've got a bunch of pictures in here. Let's see. I'm still looking for it. Give me like 30 seconds. Where is he at? Where is he at? Where is he at? so many like charts that I have on here. Does anybody know if I want to take a screenshot of my phone? Can that like maybe I need to have like my Apple Cloud handy or something, because I take so many screenshots here and I know it's like the Apple Cloud, but I'd love to just pull these up on my computer instantly. Anyway, it was probably a couple weeks ago, and point is the data that he was pulling, it showed that by historical standards, we're still very, very low unemployment, very low. Even with the trend up that we have seen, which we all admit is been scary and it triggered the SOM rule and all these things are happening. Like, we get it. But here's labor market, and let's go unemployment rate. Okay, so yes, it has gone, trending higher over the last, year and a half. How far back can I go here, gents? Can I go any further back? Can I go this far back? Yes, I can. So if we go back, I mean, this will go back to 2014. I'm going to test the edge finder here. Let's go back like 50 years. Okay, so our data doesn't go back to the 70s. All right, so we're back in here into the teens. I'll say 10 years again. Oops. There. Okay. So how did the stock market operate in the teens from 2014, 15, 16? Does anybody remember what the stock market did? So we bottomed in 2009. We essentially saw no bad years until 2015 and 16, where we went sideways. Okay. 2016 into 17, we broke and went higher. 2017 and 18, we had a vol event. Okay. 2018 into 19, we got to highs. 2019, we ripped all the way up to COVID, vol event. But this market, I mean, at 6+% unemployment, this stock market actually performed really, really well. It's just been up. So to say that's like, oh, I admit, like, we're trending in the wrong direction, right? I mean, this isn't great, but we're coming off of historically all-time lows in unemployment numbers. Even in one of like, I mean, in my career, like, I'd say 2000, 2001, pretty nasty, but I didn't know what I was doing. I was just starting trading at that time, other than just staying in the market and investing in stuff. And then 2008, everything was on sale, but nobody knew it because you thought the world was going to end. But from that point, I mean, once we bottomed in 2009, it has been exponentially higher. And we're talking about, after, yes, it took, months and months to recover, and it took years to get back to all-time highs. But once we did, and that trajectory was underway, we're talking about unemployment rates that were in the sixes. And here we are, like, freaking out at 4.3%. So even with the SOM rule activated, all that means is, yes, there's been an uptick of the 3-month trend over the 12-month low. But we're coming off of historical lows. And again, I'm not saying that I'm right, but I think there's still some slack in the labor market that could see us elevate to 4.5% or 5%. and it doesn't necessarily break the economy. It's going to be bad. Like it's going to be a Main Street slowdown, a Main Street recession, perhaps, but I don't think it necessarily crushes the overall economy. I mean, we also have to know that automation and AI, everyone's all excited about it right now until everything that we do is you either know how to use AI and you can and have the job of 2, 3, 4 people and be that much more productive, or you don't, and all of a sudden you're not working. That's my biggest concern with AI is like this AI, this automation, this, more bots. And I mean, there's humanoid stuff like this future stuff is great for bottom line, but it's terrible for jobs. Because if you can't do stuff with AI, if you're not productive enough to take the role of 2, 3, 4 people, you don't have a job. So it's not great. And I can see unemployment getting much higher than it is today, coming off these crazy historical lows, right? So I don't know. I mean, it's there. Look, there's a human element to all this, and when you have the emotions of we're trending lower in unemployment, and then we have this crazy high. Oh my gosh, everyone's never going to work again. The jobs like board up the businesses. We can't do anything other than ecom. Well, then we get back to normal, right? And the U.S. obviously got back to normal a little bit faster than most. China has never really come out of COVID like U.S. did or most of the world, but we're kind of back to normal and things are slowing down, and so we are seeing an uptick in unemployment. If I could go back a little bit further here, I'm wondering like what does it look like 10 years before that? What does it look like 30, 40, 50 years before that? Because if we've had waves and ebbs and flows of this type of volatility or ups and downs in our unemployment, what is the stock market done that whole time? I'm sure there's some correlations with higher upticks in unemployment. Maybe the stock market dips, but after that cycle is done, stock market goes higher. You know, so point is, we're coming off of very low unemployment, and I do think there's still some like softening to happen, and it doesn't necessarily break the economy. The SOM rule is a thing. The inverted yield curve is a thing. I don't take them lightly. I think they matter. I think the market can say, like, see, we told you, right? All these canary in the coal mines, like they're all over the place. But right now, it's still a bit of a wait and see. If price doesn't go lower, if price isn't going lower, right? If you want to see a recession, watch price, right? If we're breaking here and we're heading down to this gap or we're heading down to these lows, if price breaks this low, okay, now we're talking a lot more serious to the downside. But if price is just going to break, okay, price is going to break and just kind of slowly work its way down here, and then the bulls step in a big way, it's the same thing we keep seeing. There's a chance to buy it. There's a stop loss area. We get to all-time highs. If we break that high, you can measure a move, and we're talking about 590 to 600. So price ultimately will be how I make the most money in this market. Now, I don't have to be right with direction because the way that I trade options, if I can pin a price down here, pin a price in here, pin a price in here, pin a price in here, I can take trades that give me, 3, 4, 5 to 1 profit, 10 to 1 profit. I just have to catch one. I can be right, 3 out of 10 times, 2 out of 10 times, 4 out of 10 times, 8 out of 10 times. I don't have to get the perfect trade, but if it's just in my profit target, I can make some good money there. There's all sorts of ways to be nimble. So anyway, Ryan says retail 70% long on Bitcoin. Yeah. Well, but nobody sells Bitcoin though, right? Nobody sells it. I mean, the order flows in Bitcoin is retail is going to stay long. Institutions are probably staying long. I don't think I'm necessarily going to turn against the retail crowd because everybody's long Bitcoin. It is one of the most potential asymmetric trades that we have as far as something to trade, something with upside that nobody knows where it's going to stop. But if Bitcoin spot price is ever 250,000 or 500,000 or a million, I've said this for 7 or 8 years now. All I'm putting in Bitcoin is risk capital. And so if my investment is, I've got 3% of my managed portfolio in Bitcoin. And I thought it was interesting. Like if you have 1% exposure in Bitcoin, you can double your S&P returns, 1%. So I have 3% because I think there's a good upside to it. Personally, I have about 10%, and it's risk capital because if I lose a full 10%, okay, I need to make 11% somewhere else to get that back, and I can cover that hole with my other options or my other trading. But nobody really sells Bitcoin, so I think it's If it was just Bitcoin, just Coinbase, just a couple of, off the grid exchanges and everyone's just trying to hold in their Bitcoin and it's all, I'm actually happy that Bitcoin is, in the game with a BlackRock and Fidelity and, major custodians. And I think there's merit there. But I don't think anyone's really looking to sell it. I mean, if we look at the chart here, I think this is a good accumulation phase for Bitcoin. I'm watching my levels closely, right? I mean, if we were to pull back here, it's like, would anybody be surprised if we pulled back from this low to this high? We pulled it back about 50% and accumulated in here? Probably not, right? Would anybody be surprised if all of a sudden we're kind of done with this run and we get up to this upside, we pause here, and then we break and we go? I mean, everybody wants this to happen, but nobody knows how to trade that. So, but I do think it's interesting that we made so many higher highs in the S&P and the Qs this year, and we made one high in Bitcoin. So that is a legitimate concern. So I obviously don't want to see, if Bitcoin's going to fall, we're probably falling in the Qs as well. Like there's a correlation that nobody admits, but the Qs and the stock market is absolutely tied to risk sentiment, which is tied to Bitcoin. So I don't love how we've made higher highs in indexes, but we have struggled to make higher highs in Bitcoin. That's not a good thing. But the differentiator might be if the dollar takes a nosedive, gold can be up, Bitcoin can be up, risk assets can be up, and this next leg, like we had here, I mean, I think this is what gets potentially really exciting. Let's just say, now this is all like hypothetical here, but let's say that from this swing, okay, we start to see like a larger accumulation phase between this 38% zone and let's say this 61% zone, somewhere in here. Let's say that this is the best spot just to be looking to dollar cost average into Bitcoin with calculated risk. Okay. If all I did was take this move right here, okay, if I take this move right here and measure it, and we start to show some accumulation right around this 50% zone, I'm going to ballpark this and say that symmetrically, we can push up towards $100,000 or higher. Now, this move, there's no symmetry here, right? I mean, if you looked at this move here, it's like, oh, I measure that move and I measure that move and it gets back to these all-time highs. When we blew through those all-time highs, this thing still had a ridiculous amount of gains to it, right? This thing went up another 200% before it put in a top. So just because I'm measuring 100,000 does not mean that I'm getting out of that position. Because if we see a run to 100,000, we then have a pullback and then we run up again, I'd be looking to see, is there divergence? If we get super, super overbought like we did here, I was out. There was a lot of divergence on the daily and weekly charts there. We get overbought like we did here, I got out. But I'm back in and dollar cost and averaging. I'm keeping some of my core positions. So anyway, I mean, nobody knows what the hell the answer is with Bitcoin. But I do think if it's risk capital, the upside is unbelievably good. The downside is whatever you put into it, you could lose all of it. That's the downside. So I don't think anybody should be putting in money that they can't afford to lose because it truly could be zero, right? But think about how stupid people are for hanging on to GameStop and AMC and hanging on to meme stocks and hanging on to stonks. It's like you're idiots. That game is not going to work. Bitcoin, if it's calculated risk, I don't mind holding on to this one. There's a utility to it. There's a purpose for it. There's a culture behind it. This could be a huge alternative to the dollar in the future, right? Like all these things are potential. But where it goes, nobody knows. But I'm saying risk capital is it's always a decision. If I've got asymmetry, I'm pretty interested in the trade. If I can define my risk and there's good upside to it, I'll probably take the trade. So I'm a trader with this. And I think there's an investment piece to it because it could be, and this is, I think I said this last week. I would like to see, for any millennials out there that are still living in their parents' basement, anybody that's in their 20s living at home still with parents to save on costs, and maybe you're not working right now. If anybody's out there in that situation, I hope that Bitcoin is the greatest equalizer to take, maybe a $5,000 investment, maybe a $10,000 investment, and allow you to have this big leap in earnings where you can take a $5,000 or $10,000 account, turn it into 50 to 100 grand or more, and actually have some capital to then invest with a little bit more safety, invest with a little bit more diversification. That would be awesome to have it be like that type of leap forward. If it is, great. If it's not, It's just an asset like everything else that you're trying to figure out if you're going to make money or lose money. Right? So, all right, we'll see. By the way, the cost, do we have, is it time for me to go? I don't know if we have Nick Phillips coming on, but I can wrap things up. I was going to say one more thing. The mining cost right now, the average mining cost in Bitcoin is 79K. Average Bitcoin mining rate. There should be a website that I can use here. What the heck is it? Is it blockchain? Fudge. There's a website in here somewhere. Bitcoin mining costs. Come on, show me the website. There it is. Macro Micro. Right now, the average mining cost is come on, get out of here. Trying to zoom in. We're looking at the average mining cost around $73,000. We're trading at a spot price of 59. Over the years, these tend to work together. If the spot price is higher, it comes back to mining. If the spot price is lower, it comes up to mining, and it ebbs and flows. So right now we've got the edge slightly favor of higher mining costs to the spot price below. But what's interesting is when we have this go down to up or down to up or down to up, you know, those rips to the upside tend to be pretty exciting for those that are holding. So anyway, all right, I'll let you go in case I'm getting yanked off the stage. But thanks for being with me today on this segment for A1 Trading. And happy Friday. Have a great Labor Day weekend. And I think we're going to be back tomorrow. I don't know. But I'll leave. All right, see you later. Bye.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hello. Welcome to this segment of the A1 Trading Show. Happy to be back here with you guys. Just scrolling up to get to the top of my news terminal here, see if there's any major notices this morning. I have not been too heavily involved with the market today. I have been trying to get some stuff set up in my office for some of my YouTube stuff coming up. So let's see. OPEC is likely to proceed with a planned gradual oil production increase from October. Okay, so decent example here of something that I would love to take advantage of had I been paying attention to this morning. A straight drop the moment this was decided. Let's go see how oil ended up playing out. Did it keep its? Yeah, massive drop to the downside. So a bit of supply issue, or a bit of a supply note here. OPEC is likely to proceed with planned gradual oil production increase from October. So they're planning to continue to increase oil production, which doesn't necessarily flood the market with supply, but it adds supply to the market. And we see as soon as that headline kind of drops, boom, big fall off in the price of oil. So interesting little trade opportunity that happened this morning that I missed. Other than that, nothing else really in news. PCE didn't really surprise too much. Yeah, so let's go take a look at some charts here. Take a look at the Doxy. Scale out here a bit. So I believe it was the last time I was on the show, which was when? Let me check this out real quick. Okay, so last week, which seems about right. Okay, so sometimes I get confused on whether or not I've gone over this, some of these things with the A1 show, or if I've gone over them with my private group. But at this point in the game with the Doxy, some of this rallying that we've been seeing this week has, you see headlines, oh, the Doxy strength is back, blah, blah, blah. Like people claiming Doxy strong just because we get a bit of a pullback. For me, I'm not going to consider the Doxy to be entering into like a resurgence of any bullishness, really, until we break past these levels, like a solid break, and we're trading in this area. Once we're trading in this area, then to me it becomes a game of um, one, further economic data, of course, but two, on a technical side of things, are we going to treat this previous support as new resistance, or are we going to have a real dollar rally here? Which for me, one of my favorite patterns is the head and shoulders pattern. So you can start to see this sort of forming. This would be a long time forming, at least maybe another month or two. Not two, maybe more like a month, month and a half, if it forms properly, I should say. So I could see a couple things happening. One, if we break past this, so this is a big if we break and hold past this level, then I can see us coming up here to the 102.25 area. And we have another major point of contention on price action side of things. Are we going to reject this area and get a bit of a previous support becoming new resistance? Or are we going to trade up into this little zone here, reject these highs, come down, form this right shoulder, inverted shoulder, I should say, and trade back to the upside? This is, if I had a reason to buy the dollar, that would be my ideal opportunity to get in on dollar buys. I would love to see that kind of a pattern play out. However, dollar strength is not necessarily my bias currently. I will say that we are obviously major levels here on the daily, levels that we tapped into the beginning of last year, the spring of last year, kind of broke, but then ultimately ended up rallying back past summer of last year. Then again at the end of last year, and this is the first time we've tapped back into this price area since December of 2023. So around this time, this is when the Fed started talking about rate cuts coming for 2024, and the markets were starting to price in quite a few of those, and so we were dropping significantly. So I'll be interested to see how price moves from here with the implied interest rate decisions coming down the line. So that's a doxy for me. That's the way I would be looking to trade this right now. Like moving into next week, it's interesting because we have NFP, but again, on a technical only basis, I'd be looking to sell from this area, even if it's just little scalps, because that's the way I tend to trade is scalping these areas. So I would see that we're at a major resistance here. I'll drop down to something like the 2-minute, try to identify some more areas where price reacted from heavily before. And when I'm scalping, I drop down as low as the 5 or the 15 second and scalp out. Now, granted, this is the Doxy, so I'm not actively trading the dollar index. I'm using this as a guide to get me in on other currencies like the yen or the Australian dollar or the Canadian dollar. All right, so now that we've touched on the Doxy a bit, let's go look at NASDAQ. NASDAQ, now this was something I remember talking about last week with the A1 trading show. And price still hasn't hit here yet, but it's barely tapped into this area here on the 4 hour. What I was mentioning last week about this, again, you're seeing my favorite pattern play out here. Shoulder, head, shoulder. And then on a smaller time frame, if you zoom in, I would like to see another little head and shoulders, inverted head and shoulders here playing out in my buy zone. This one's tricky because we did kind of tap here. We do have this inverted head and shoulders pattern playing out currently. I don't love it because it didn't quite come down as far into this support zone as I would like to have seen, closer towards that flat 19,000 number, 18.8. In an ideal world, I get this exact same thing. I get this price action pattern, but let it happen down in these levels. That's ideal for me. Doxy to scalp 2 on 5 minute. What do I think about gold? I personally think it's going to make a pullback until the 2450. Let's see. I kind of feel like just a broken record on gold. Gold has not done much since the last time I touched on it here on the stream. This is a prime example of why I tend to trade. Like my number one way of trading is economic data. The data hits the market. If the data was a surprise, a massive surprise based on what we were expecting, then the market, the thesis behind trading red folder news the way I do is the market has to recalibrate to new fundamental information. If we are currently pricing in a certain amount of information from economic data, like PCE this morning, let's say PCE had surprised massively to the upside, just absolutely blew the minds of the entire market. We would expect the Doxy to recalibrate. We would expect gold to recalibrate, equities to recalibrate, all these assets to recalibrate based on the new PCE information. So for me, I'm within my group, I'm scalping the 5-second chart. Let's say PCE drops right here at this. Within 5 to 10 seconds, I'm getting in and I'm taking advantage of these little scalps. Now, the way that if you're trading Forex, it might feel impossible simply due to the spreads that you're dealing with. I trade currencies on the futures market, so my spread is significantly lower, like almost non-existent. So it's much easier. The commissions are much lower as well. So it's much easier to trade the way I trade when you're trading on the futures market. But this price action out of gold is a prime example of why I mostly trade the way I trade, is because let's see, since the 19th of August, price has just been sideways. It's not making any headway up, any real headway down. It is just sideways. And we haven't had much impactful economic data in the last couple weeks. So this makes perfect sense to me. There's not a world of the last couple weeks where this price action makes me go, huh? Like, I wonder why it's doing that. Like, no, this makes perfect sense to me. There's been nothing new. So prices sort of just hit this area and stalled out. Doesn't really know where to go. So for me, 24.50. Now, you're talking about a slight pullback back into this channel. I could see that happening for sure. One of the things that I mentioned before that I would like to have seen if I wanted to get involved in gold to the upside would be a very big push past this zone. And this really wasn't enough of a move for me to consider it to be big. Like, I need a nice sustained, at least a couple days worth of a push, and then a pullback, and then continued strength. And I would love to get in on this leg somewhere in here. I don't need the whole move. I'm not trying to get in at the bottom and get out at the top. I just want to see this happen on the 1 hour, 2 hour, 4 hour time frame, jump in on really small time frames and eat little bites of this leg on the way up. That's it. But as far as where gold's going to go from here, yeah, I mean, this, I got a 50-50 shot of getting this right. That's the way I look at it. It's either going to go up or it's going to go down. I have no indications and no reasons to get in either direction. On an overall fundamental bias, I would say gold upside still. But do I want to buy at these levels? Absolutely not. Not with this certain price action. Now, with that being said, if gold was to come back into this area without any massive changes fundamentally, without anything that truly devalues gold in a massive way, if gold was to come back into any of these areas, retouching this support, this level, if it was to come back down to the bottom of this channel, I would absolutely be looking for reasons to get in. I would absolutely drop down to the 10-minute, 5-minute, wait for a decent 15-minute, wait for a decent little price action pattern here, reversal pattern at the bottom of this channel, and try to buy this back up. 110%, that would be a worthwhile trade for me. Now, is it worthwhile to try to sell it just because it's hit the top of this range? No, not for me personally, because I haven't gotten a good enough indication that it wants to go south from here. So if there's any case for selling gold right now, it's this. It's at the top of this channel. It hit the top of this channel. What was this? Almost 2 weeks ago. It is flatlined at the top of this channel. Has not been able to push past this 25-30 range once, twice, 3 times, 4 times, 5 times it's attempted to push up past this 25-30. Hasn't been able to do it. So it's almost like the opposite concept of trying to catch a falling knife, right? Like, you don't want to be selling as we're pushing up massively here on these legs right here. This is like, it's like the opposite of trying to catch a falling knife. You're just trying to sell it because it's gone bullish. However, this is no longer a falling knife. Let's invert this chart just so this makes a little bit more sense as I'm talking about this. Invert scale. Okay. So as price is falling, you don't just want to be buying because it's dropping to the downside, right? This is no longer a falling knife. This knife fell and has since hit the ground and is yet to continue to fall. So you have some decent opportunity or decent reasons to trade this to the downside. I would say on technical reasons only. No fundamental bias is baked into this idea at all. On a technical basis, yeah, absolutely. Now, if we scale in here, moving into next week is going to be a little interesting, but I would say some areas that you could look to sell from would be this batch of price action if price pops up back above here, I would say this area of resistance. And if we don't get that, if we don't get a push back up into either one of those zones, I would say selling something like this. So first scenario, price pushes back up into here. Obviously, best case scenario, because you get some of the best pricing for your short positions. And then a secondary option, be here. Not quite as good pricing wise, but a decent area of previous support and resistance. Prices played off of multiple times. And then the third trading option could be something like this. We get a strong break below this level, retest, and continuation. Then, of course, you want to scale in, or the way that I would approach this is scaling in once we, let's say price comes up into here, scale into the 2-minute and look for solid indications of price action, rejecting this area. Some of the ways you can do it is look for double tops, neckline breaks, retest. I tend to read price action almost candlestick by candlestick. So some of the things that I like to do is if I'm looking for a sell position at a certain level, let's say I was looking for a sell position at this level and prices will go, this is the level I'm looking to sell from. Now, this is hindsight talking, giving an example. So obviously I'm going to be right when I say this, but this is just for kind of illustration purposes here. So let's say I identified this level based on previous price action happening to the left here. Well, once price comes into this area, I see it rejecting. Okay, cool. Not quite enough for me to want to get involved yet. Okay, pops back up in to this area with a relatively strong bit of volume here, and then immediately gets rejected. Cool. It's looking better, still not enough for me. Okay, we pop back up into here and we reject again. This may be where I'm getting in. Slight risk here. Let it play out a little bit, stops above these levels. And then we get this second big rejection from this zone. Then I'm getting in at, whatever my full risk, whatever your full risk parameter would be. That's the way that I tend to go about some of these technical only trades. Identify key areas, wait for a decent price action pattern, or simply relying on tape reading, classical tape reading. If you guys don't tape read, I highly encourage you to tape read. That literally means going candlestick by candlestick and talking it through. I mean, I do it mentally now, and I talk it through sometimes with my guys on the live calls. But you really want to tell the story of price action candlestick by candlestick, and it's a little. I find it easier to do it when you're talking about like a 5-second candle. When you're talking about 15-second candles, because they're forming so fast that it's not like you're waiting around for 2 minutes or 5 minutes to tell the story of what happened in that next candle. So for me right now, if we're talking about tape reading, got to play a little bit of catch up here. Prices hit this support area, rejected a couple times, rejected, hasn't really been able to make new highs. See, lower high here, lower low, higher high. So we're sort of just in some consolidation, not a real great area to talk through price action with. But if we zoom in here, I do like this little bit of, again, my favorite pattern. Shoulder, head, shoulder. So something to look for in this area would be some nice rejection. Now, this becomes a matter of where do you take it, but decent little scalping buy opportunity into here. And then, I may want to get out here or here just because I'm not trying to play price too high. And immediately we see this would have been stop loss. I would have gotten taken out here immediately. And I actually would not have taken this trade if we're playing a pretend scenario. I wouldn't have taken this trade because we were coming up on the 30-minute mark. When I'm scalping on these lower time frames like this, I'm telling the story of price action, but I'm also paying attention to the time. I don't want to jump in before any new 1 hour, 30 minutes, 15 minutes is sometimes a little dangerous to jump in and get involved with. So, but yeah, long story short, gold, I could see some downside, but I have no real reasons to get involved in either direction. All right, let me scroll through some of these questions real quick. What do I think about pound Swiss? I'm going to take a look at this. Both relatively strong on the daily. Both of them having some similar price action here where we've had this decent push up, slight pullback, finding some support. So the pound and the Swiss, they're, as far as on an index scale, they're both relatively behaving the same. So I tend to avoid I mean, I don't trade cross pairs like this anymore, but if I was still trading CFD cross pairs, I wouldn't even bother with this simply because these are behaving very similarly right now. So it's not a great example because neither one of them is overtly strong or overtly weak, but let's play again another pretend scenario here. Let's imagine this leg is everything we needed to know about both of these currencies. They're both skewed to the downside, right? So they're both incredibly weak. I don't want to trade a weak currency versus another weak currency because they're not going to stalemate each other, but there's better options. So let's say we have an incredibly weak pound. I would want to pair that against something incredibly strong. It doesn't seem like many of the currencies are incredibly strong right now. NZD is not bad. NZD's kind of had a decent month. So we'll just pretend pound NZD would be a better alternative to pound Swiss currently, just because the pricing models between the two, they're the antithesis. So we have again, we're kind of playing pretend because the positioning of the pound isn't really great right now. Pretending that we had a weak pound, you would want to pair that against a strong something else. And the CHF and the pound seem to be relatively performing relatively the same. And then when you jump over to the pound and the Swiss chart, you can see that it's evident right here in the last few days of price action. Really like the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. The last 11 days of price action have seen the pound doing what? Going sideways, because both of these currencies are behaving very similarly. So it's hard for one to gain ground over the other when they're both on an index level relatively as strong as the other one. Let me see if I can pull up another strength chart here. Scale out to the day. And you can see right here, We have this starting basically back in March of 2023. The pound and the Swiss are both the two strongest currencies right now. They're literally both right here. If we scale in a little bit, we can start this chart. Let's start this chart back in May. So we'll put May to the left, beginning of May ish. Swiss is stronger than the pound. Pound is relatively flat, relatively neutral. I would say it's not necessarily in bearish territory. But Swiss is stronger than the pound here. So some of this is going to depend also on what kind of trade you're trying to take. Are you trying to take a scalp? Are you trying to take a swing trade? Are you looking to do boost with Nico, I believe? What kind of a trade are you looking for? Are you looking to get involved in pound Swiss on a swing trade? Are you looking for intraday action? Are you looking for a scalp? Hit me up and let me know. So should I close buys because I'm running in losses, boss? Well, first of all, can't give you any investment advice. That's not what I'm here to do. I would say on a educational side of things, you just want to make sure you're protected. You want to make sure your losses are protected. If you're, I don't know how you're trading. I don't know what kind of account you're trading through, but proper risk management. For me, some of that looks like creating tiers for my trades. So A tier, B tier, C tier. Anything that is A tier will get about 0.5% to 1% of risk. And 1% is like, I don't even like to touch a full percent of risk. So really like 3/4, 1/2 to 3/4. B tier is going to be 1/4 to 0.5%. And then C tier is 1/8% to 1/4% risk. And that's essentially the way that I go about it. And most of my trades exist at the B tier level. It's an A tier is like, this is a gimme trade. It's sitting right there waiting for me to get involved. Let's say something fundamentally happened that was insane. Like, I'm just going to come up with the most insane analogy. Aliens invade and Russia starts a nuclear war in space with some alien race, right? The world goes to war. Okay, I'm immediately buying gold and I'm going to go full. That's an A tier trade. Now, granted, I also want to see gold going to the upside. I want to see the market reacting in real time. So we get invaded right this second from aliens and gold starts to rally to the upside. That's an A tier trade for me. I'm getting in something real world happen. The markets are reflecting the sentiment. I want to be involved in that recalibration as the risk sentiment hits the market. What's your take on GBP CAD? Let's see. I'm gonna touch a couple more of these, and then it may be maybe relatively close for me to have to sign off here. Okay. So I have two currency strength indexes that I use. This one has session breaks where I can take the chart and scroll it all the way to the left where the session break starts, and then I can see right here real quick the weakest currencies on the session and the strongest currencies on the session and the currencies on the session that really aren't doing anything. So currently, USD, the US dollar is the strongest on the session, and the yen is the weakest. So, you asked about GBP CAD though. Let me touch on that. So, CAD is stronger than the pound. So you're looking at possibly some GCAD downside. Just looking at this from a very basic level, like not doing more than 2 minutes of technical analysis on this, I would be wanting to be involved in this buy back to the upside. Again, why? Well, we're at a major 5-level area of support. Price touched into here, flew away for at least, what was this? A 24-hour period. Came back. We're now rejecting this low again. At the rejection of the low, we're getting this head and shoulders pattern. And buying in at this 177233 area, great opportunity. Now, if you have a better bias for this, which I tend to not just want to trade technicals, like this isn't something I like. This is not an A tier trade. This would be a C tier trade for me. I'd probably put about 1/8% of risk in this trade just because I'm purely getting involved in these buy on a technical idea. If I just have a technical idea, there's no way this is a B tier trade. That's C tier all day. So C tier entry, super low risk, and I'll be targeting a couple things. I'll be targeting this level here, and then this level here, and then probably not holding much farther beyond that. I don't want to get involved in a heavy rejection and lose or go break even on this kind of a trade. I'll just take my wins here at these levels and get out. Now, because we saw CAD strong and pound weak on the indexes, another option that I would go for when it comes to trading this would be letting price come back into this area of consolidation. Had a major batch of consolidation all throughout this area. If price comes back up into here and gives me a reversal pattern in here, I would sell it from this area to the downside. But as far as where price is at currently, I certainly wouldn't be selling this here because we're at these lows. I don't like to sell into lows, and I don't like to buy into highs. And I think that's a pretty good, solid approach to the market. It has served me well. Pretty much every time I sell into lows, I'm banking on price breaking those lows, and it's almost a gamble if you don't have a fundamental reason for that to happen. So that's GCAD for me. I'd be buying it up from this area up into here, and either way, I'd be looking to sell it out of this zone once it comes back up into this area. If it comes back up into this area, it might not. But if it does, I would definitely be looking to sell it out of there. So actually looking for a buy. Yeah, I mean, this is honestly, if you're looking to get in on buy and you're looking for a scalp, again, this is not a larger time frame analysis by any means, but you're at a decent 1 hour area of support. A better 1 hour area of support is going to be right here, the 1.76357 area. But you're at a decent little area of support here on GCAD. Yeah, so, another good little area is right here. But if you get the right price action indications on some of these lower time frames, which this is not a bad little signal here. But again, just make sure, if it's me, I'm managing my risk properly. I'm getting in this because it's a technical only reason. No fundamentals baked into this. Incredibly low risk. Just grabbing a little something to eat here. And if it breaks down back towards this head, it could form a double bottom, but my idea is kind of wrong at that point. I want to get in here. So I'll eat the 1/8% loss. If it taps back down into here, gives a double bottom, and then goes back up. So let's say it comes into here, breaks, does a double bottom. I get taken out. Well, then what I would look for is simply the neckline break, retest, and I'll get involved over here to trade back up into this zone. So yeah, that's how I would approach GCAD. Not that I'm going to. I don't trade these currency pairs anymore just because I left the CFD space for the most part. I still have an account open there, but I just don't trade it. All right, guys. I think that's about it for me. I've gone a little bit longer than I think I was supposed to, but I will see you guys around. Feel free to follow me here on YouTube and Instagram at official Nick Phillips. Got some exciting things coming for you guys. And if you're not already, make sure to follow A1 Trading. And I will see you guys next week.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.